Yeah. Hi. I guess we are online. 1 minute, just I'll confirm.
Sure, sure.
Yes. Yes. So good afternoon, guys. We are resuming FM classes with Thofik sir. So let's resume. Sorry for the delay. There was some technical glitch and we couldn't start on time. So uh, let's start, sir.
Yeah, okay, sure, sure. So good afternoon. So yeah, before starting, I would like to tell that if you have any doubts, so you can put it in the live chat. In the end, we are going to discuss. So this is the last session for today's. This is the last session for FM revision. So we completed capital budgeting in the last class. So first class we completed some first session we completed some 4 chapter. Second session, I think we went a bit slow and then we completed this capital budgeting chapter. But I hope the capital budgeting chapter is covered in properly entirety. I think one topic I would have missed is MIRR. So MIRR is also a simple topic. You can look into it. Here only one more rate will come in, which is reinvestment rate. So it is nothing but all the cash flows you have to reinvest. You have to reinvest and then you have to find the future value, and then you have to compare this future value and present value to find the rate. That is what is MIRR. Fine. So MIRR is a simple concept. You can check how to calculate it. Now let us come into risk analysis in capital budgeting. As I said, risk analysis in capital budgeting, I'm expecting one question. Risk analysis in capital budgeting is very simple and no big calculations are involved. It is purely and purely multiplication. Two numbers will be given, multiply two numbers and get the answer. It is that much easy. But what number to multiply, where to multiply, this is what we have to understand. So risk analysis in capital budgeting, we have few techniques. As I said, no, first of all, why risk analysis? See, capital budgeting, we have to estimate cash flows. Everyone knows we have to estimate cash flows. Cash flows are future cash flows. Okay. Now, those future cash flows involve some amount of risk. Correct? It involves some amount of risk. If I am telling first year, second year, third year, I am getting a cash inflow. Okay. I am getting a cash inflow of 100, 300 and 400. I cannot say with certainty that definitely I will receive 100 rupees, definitely I will receive 300 rupees, or definitely I can receive 400 rupees. No one can predict future, even God. I mean, okay, only God knows the future. Okay, no one can predict future. No finance manager can predict the future. So even though we cannot predict the cash flow, but at least we can include the risk element, and then we can you can do some adjustment in cash flows to bring the risk adjusted cash flows. So that is where is we have to find out the risk analysis in capital budgeting. We are just analyzing the risk in capital budgeting. Where risk will be there? Risk will be there only in two places. We only do cash flows and then multiply the present value factor. So risk can be there at only two places. One will be the cash flow, another will be the discounting factor. Okay, these two are the only variables where we will include or exclude the risk element as and when the question is required. So there are, it is a very solid concept. Everything is, very structured. So let us see. First, we will see we in risk analysis in capital budgeting also we have a few techniques. Okay, first will be statistical analysis. Statistical analysis. In statistical analysis, it is nothing but we have to find variance, standard deviation, coefficient of variation. These three are included. All these three already studied in foundation. Okay. But we will see how to calculate it, because we have one more thing is expected value method. Okay. Expected value, that also you discuss. Once I will show you the problem, you will be comfortable. Nothing great is there in statistical analysis. Okay. I'll just go through the problems. I even don't want to explain what is expected value. What is expected value? Suppose if I have a cash flow. Okay. Suppose if I'm having a cash flow of 300 rupees, 200 rupees and 400 rupees. I will tell the probability. Okay, the probability, there is a 50% probability that I will get the cash flow of 300 rupees. There is a 30% probability that I'll get the cash flow of 200 rupees, and there is a 20% probability that I will get the cash flow of 400 rupees. So which cash flow you will take in year one? Which cash flow you will take? 300, 200 or 400? So what we are telling, we will take the average cash flow. What is average? Weighted average cash flow. So we will find out something called as expected cash flow. Okay. So we will calculate expected value. So expected value will be, this will be 150. This will be 200 into 30%, 60, and this will be 80. So we will get something 140 plus 150 is equal to 290 rupees. Now you all will be thinking 300 is one cash flow, 200, there are only three scenarios possible. 300 is one cash flow, 200 is one cash flow, 400 is one cash flow. But on an average, we are taking 290 is the cash flow, so that we will not have, any surprises. If tomorrow this probability works or this probability works, we should not have any surprises. So that is the reason we have already discounted everything. Discounted means not discount time, the time value of money discounting. This is the probability discounting. So we have discounted this probability, and then we calculate something called as expected value. So first year expected value, second year expected value, third year expected value, and normally calculate the NPV. This is what is expected value method. Okay, nothing great is there. Variance and standard deviation already know. Okay, sigma x minus x dash the whole square divided by n, the whole cube. The whole square is standard deviation. Okay, is standard deviation. Variance is equal to standard deviation square. So how to calculate this? Everything we will see in one problem. Okay, everything we'll see in one problem. Statistical techniques. Let me just complete this first one. Risk analysis in capital budgeting. See, I will tell you, if you get a problem in risk analysis in capital budgeting, you are very lucky, and definitely you are lucky, because definitely you are going to get a problem. It is so simple. It is so simple. Okay, it is very simple. Now see, you have 5 events. Okay, and this is the cash flow from project A, this is the cash flow from project B. Cash flows are given, probability is given. Just calculate the expected value here, calculate the expected value here. Okay, and wherever the expected value, so this is the first year cash flow, correct? Yeah, this is the first year cash flow. So since this is the first year cash flow, you do divided by 1 plus I, you will get the 0th year cash flow, which means present value factor for 1 year. Okay, and you have the discounting rate as 1%. So 1 divided by 1.1 is 0.909. So first calculate the expected cash flow and multiply it by 0.909. You will get the net present value. So you got the net present value. Nothing but it, cash flow into probability is the expected value, total the expected value, and in that expected value, because this is the first year cash flow. Okay, this is the first year cash flow, one period, first year cash flow. That is the reason we discounted for 1 year. Now this is a multi-period cash flow. This is multi-period cash flow. You have year 1, you have year 2, you have year 3. So what you will do, you will find out the expected value for year 1, expected value for year 2, expected value for year 3. And then year 1 value you will multiply with year 1 present value factor. This will be year 2 present value factor, and this will be year 3 present value factor, because cash flows of 3 years are given. So as you can see, these are the expected values, and you multiply this with the present value of first year, present value of second year, present value of third year. You will get the present value. Okay, you will get the present value of cash outflow, and then the present value of cash inflow is 10,000 rupees. Once you reduce this present value of cash outflow, present value of cash inflow minus present value of cash outflow, you will get the expected net present value, and this is the expected net present value. Okay, so I think expected net present value does not require any kind of explanation, because it is very simple as that. Second one, variance. Okay, variance, just see this formula, x minus x dash. What is variance? Okay, first of all, what is variance? Variance is mean deviation. It is mean deviation, which means how our cash flows are deviating from average. So what is average? Average is equal to x dash. Suppose if I'm having a cash flow 100, 300, 500 rupees and 100 rupees, what is my average? 600, 600, 900, and then 1000 divided by 4 is 250. Okay, so 250 is my average. So if 250 is my average, how this number is deviating with average? If my average is 250, so what is x minus x dash? 100 minus 250. Okay, minus 150. 300 minus 250 is plus 50. 500 minus 250 is 250. 100 minus 250 is plus 150. 1 minute. Yeah, this is negative. Okay. So negative, because 100 minus 250, this will become negative 150 rupees. So as you can see, you got x minus x dash. So this is called the mean deviation. Now directly you cannot add, correct? Directly you cannot add the mean deviation. So what we are doing to remove this, square, so to remove this negative thing, what we are doing, we are doing x minus x dash the whole square. If you do whole square, this negative number will be removed. So now you will get some values. All values will be positive. You add all those values, then you take the average, and then you take the square root. This is what is the concept of standard deviation. But this concept of standard deviation will work only if there is a if there is simple average, because I am doing divided by 4, but here divided by n. But here, since we are having probability, we have to multiply it with probability. We don't have to do divide by n, because if it is dividing by n, I am actually assuming that everyone is having same weight. But here, since every cash flow will have a different weight, so what I will do, I have to do into P. So just see this question. Just one minute. Yeah. This is the cash flow. This is the probability. First, you have to calculate the expected value. You calculated the expected value for project A and you calculated the expected value for project B. Actually, it would have been better if we did in a table format. 1 minute. So once after finding the expected value, what you have to do is that x minus x dash the whole square into P. This is what you have to do. See, x 8,000 minus x dash, which is 12,000. This is x dash, weighted average. Divide by 4 na simple average. This is weighted average. So x minus x dash the whole square into what is the probability, into P. Okay, x minus x dash into P. So this will be the variance. If you square root this, this will be the standard deviation. I hope there is no doubt in this. There is no doubt in this. If no probabilities are given, then you can do divided by 5. But here probabilities are given, so you have to take the weighted average, not the simple average. I hope no doubts are there here. If you're having any doubt, you can put it in the comment section. I'll be able to see and respond it, okay? Okay, done. So this is what, see, statistical techniques, there is a 50% chance, I'm telling you this, there is a 50% chance that the question will hit from statistical techniques. Okay, there is a 50% chance, because mostly the institute's favorite thing is asking from statistical techniques, and it is very easy. The only thing is things become lengthy only if you don't know. If you don't know, then things become lengthy. But once you know how to do it, these things are very easy. Okay. Yeah, and coefficient of variation is nothing. Okay, coefficient of variation is standard deviation divided by the mean. Okay, standard deviation divided by mean. This is called the coefficient of variation. Now they are asking to calculate the coefficient of variation. So to calculate the coefficient of variation, first you have to find out the standard deviation. How to calculate the standard deviation? First, find out the expected value. This is x dash, this is y dash. Okay, two projects. Okay, a dash, y dash. Now find out the standard deviation. X minus x dash, 10 minus 14,000. Okay, the whole square, 10 minus 14,000 the whole square into the probability. Same way, 12 minus 14,000 the whole square into 0.2. You can do it in the table way. Okay, you can do it x minus x dash first, and then x minus x dash the whole square, and then x minus x dash the whole square into P. And then once you total that, that total will be the variance. You square root that, you will get the standard deviation. Where many people make mistake is that they will forget to do the square root. When you will forget to do the square root, when you don't know the formula. Okay, so always That is the reason many people say that always calculate the variance first, so that there is no confusion when to put a square root, when to not put a square root, even though they're asking standard deviation. Now here standard deviation is what they've asked, but still they calculated variance and then they did square root of variance to calculate the standard deviation. Okay, so project B, standard deviation of A, standard deviation of B, we got it. Okay, but from standard deviation, okay, one more thing, how to take a decision. What is standard deviation? What is standard deviation? Standard deviation is known as the risk. Okay, standard deviation is known as the risk. So the more the standard deviation, the more is the risk. So as you can see here, risk, wherever standard deviation is more, the risk is more. Okay, wherever the standard deviation is more, the risk is more. So first you have to find out the coefficient of variation. The coefficient of variation, standard deviation 2190 divided by expected value 14,000. It is 0.1595. It is 0.2331. Okay. So this is what they're asking. This thing, even if you don't do in exam, it's okay. What they have asked is this one. Coefficient of variation. See, statistical techniques is what we have completed. Statistical techniques, 50% chance statistical questions will hit. Okay, statistical techniques will hit. Now we have other techniques. Other techniques are nothing great. It is purely NPV. It is purely NPV with some adjustments. NPV with some adjustments. If you know how to calculate NPV, all the other techniques will become a cakewalk for you. Okay. Now, what are the other techniques? I'll go by the order of importance. Okay. First is sensitivity analysis. Okay, sensitivity analysis. Now, what is sensitivity analysis? Okay, what is sensitivity analysis? See, whenever you are calculating any NPV calculation, how you will calculate? Sales minus variable cost, that will bring the contribution. Okay, minus fixed cost, you will get the earnings before interest and taxes. Okay, then suppose say no interest are there, you just have to put taxes. Okay, and then you will get earnings after tax. If in the fixed cost depreciation is there, then you have to add back the depreciation, and end of the day you should bring the cash flows. Okay, cash flows. That cash flow you have to multiply with present value factor. You will get something called as NPV. Okay, you will get something called as NPV. Now what is sensitivity analysis? Is that sales is sales volume into selling price, correct? Volume into selling price. Variable cost is volume into variable cost per unit. This is also selling price per unit. Okay, fixed cost will be fixed. Okay, so all these things are there. Now, what is sensitivity analysis? First, understand what is sensitivity analysis. Sensitivity analysis is that to find out which factor is more sensitive to decision making. Which factor is more sensitive to decision making? I didn't understand, sir. What is sensitivity? Okay, now if I change my selling price, if I increase my selling price to 10%, what will be the impact on NPV? If I change my fixed cost, if I increase my fixed cost by 10%, what will be my impact on NPV? Okay, if I increase my discounting factor by 10%, what will be the impact on my NPV? This is what you have to calculate. So what is this, sir? Every time we have to change the factors, then we have to calculate NPV. Yes, yeah. If three factors are changed, then you have to find out three NPVs. You have to find out three NPVs, and out of those three NPVs, you have to find out which factor is more sensitive. That is what is sensitivity analysis. From sensitivity analysis, you will not be able to take any decision, but from sensitivity analysis, what you will able to get it, if selling price is more sensitive, so you will fear more. So whenever selling price is getting you'll be happy. Okay, if variable cost is sensitive, then you will be fear more. If selling price is sensitive, then you will be very happy. Okay, if selling price is increasing, then you will be very happy. Even though the same way, if selling price is decreasing, then you will be very sad. Okay, so what thing you have to know is that you are understanding 1 rupee increase in selling price or 1% increase in selling price is having how many percent increase in NPV, or how many percent decrease in NPV if variable cost is there. That is what is sensitivity analysis. See, theoretical discussion will not do. This is a completely practical thing. So I will just show you the problem, how a sensitivity analysis problem looks like. Because in this chapter alone, discussion is not important. In this chapter, what is important is seeing the problem and getting a comfort over the problem is what is important. So we have our sensitivity analysis here, I think, on it. This is certainty equivalent, risk adjusted values, certainty equivalent, scenario analysis. Okay, we have illustration. Just 1 minute. Okay. See, this is the problem. This is the problem of sensitivity analysis. But yeah, this problem looks very big, but don't worry, this big problem will not come in exam. In exam, maximum 3 factors can be asked. Okay. Now here, if you see factor 1, factor 2, factor 3, factor 4, factor 5. 5 factors have asked this. So that is the reason you have calculated 5 different MPVs. But in exam, maximum 3 factors can be asked. Okay, 6-mark problem, maximum 3 factors can be asked, and it will be very simple. Okay, it will not be so this is a big problem, but in exam this problem cannot come. Okay, don't worry about it. I have seen many papers, in usually the papers 3 factors will come, or they will reduce, or they will not give selling price variable cost. They will directly give the cash flows. Okay. Now here, just read the question. Details are given. Initial cash outlay. So year 0 amount is given. Okay. Annual sales is given. Selling price per unit is given. Variable cost per unit is given. Fixed cost is given. Now using all this, you have to prepare an income statement. Okay. Base income statement, everyone can prepare. Selling price per unit, variable cost per unit. Then you will get contribution per unit. Okay. Then you will get total contribution. So contribution minus fixed cost. Contribution minus fixed cost is equal to cash flow, because is equal to profit. We don't have any other impact. So that becomes the cash flow. Correct. So that becomes the cash flow. As you see, selling price, variable cost, contribution. So 250 is our total contribution. Fixed cost is 50. And then you will get the cash flow of 200. Okay, 100 minus 50, 50 is the contribution. 50 into 5 crore, 250 crore is this, 250 crore is contribution. 250 minus 50 fixed cost, so 200 crore is the profit. No other non-cash adjustment is there, so 200 will become the cash inflow. Okay, 200 will become the cash inflow. Now 200, what is the life of the project? What is the life of the project? The life of the project is 3 years. Okay, so annual cash inflow is equal to 200 crore for 3 years. And what is my cash outflow? So it will become year 0, 1, 2 and 3. Year 0 it is 400 negative, and 1, 2, 3 is 200, 200, 200. Simple. Everything is very simple. Correct. Now you have to calculate the net present value. This net present value is 134.6. This net present value is 134.6. This is what they have asked. This is what they've asked. The first thing, net present value, very simple. Second one, compute the impact on project's NPV considering 2.5% adverse variance. So each factor you have to apply a 2.5% adverse. Now what is this adverse variance? Adverse variance means something which is not favorable to us. So selling price, if it is selling price, what will be unfavorable thing for us? Selling price reducing. So reduce selling price by 2.5%. Okay. What is the second thing? Variable cost. Variable cost, what will be adverse for us if variable cost is increased? So increase variable cost by 2.5%. So that will only become an adverse variance. Correct. Adverse variance, now don't think standard costing this, that. Adverse variance is nothing but something which is not favorable to us. Now if fixed cost is a cost, correct, when fixed cost will become unfavorable if fixed cost increase. So increase the fixed cost by 2.5%. Okay, then what other variables we have? Discounting rate is one more variable. I think discounting rate they have used. Yeah, discounting rate they have not used. Okay. Now what is another variable? Yeah, in exam usually which factor you have to change, it will given. In this question you have to change all the factors. Okay, in this question you have to change in each variable. Okay, all the variables you have to change, but in exam directly it will given. Okay, directly what variables you have to change, it will given. What is another variable what we can change? Unit sold I can change, correct? So unit sold, when it will become adverse for us, when unit sold gets reduced. So reduce unit sold by 2.5 percentage. What is another variable we have? Initial cash outlay. Okay, initial cash outlay. Initial cash outlay, when it will become adverse for us, when my cash outlay is more, then it is not favorable for me. So increase my cash outlay by 2.5 percentage. I will tell you how to approach the problem. Okay, first you write the base thing. The base is nothing. This is what the same thing is copied here. Okay, base is nothing. The same thing, this 134.6, the same thing is copied here. Okay, this is what is the base thing. First you always make a base thing, then factor 1, factor 2, factor 3, factor 4, factor 5. Here first factor is initial capital cost. Okay, capital cost we have to increase. Okay, capital cost is increased by 2.5 percentage. So increase the capital cost 2.5 percentage. What is the initial capital? Initial capital is 400. So 400 plus 2.5 percentage will become 410. So you change initial capital outlay to 400, initial capital outlay to 410, and keep all other factors same. Okay, keep all other factors same. Everything you keep same. Okay, everything you keep same. Just change this to 410 and see what is the NPV. Your NPV is becoming 124.6. And what is the percentage change in NPV? So from 134 to 124, so it has been reduced to 7.43 percentage. How to calculate this 7.43 percentage? 124. Okay, 124.6 is now the NPV after changing. What was the base NPV? 134.6. So how much it has reduced? 10 rupee it has reduced. This 10 rupee has been reduced from where? 134.6. Okay, so you will get 7.43 percentage. 10 rupees reduced from 134.6. So 10 rupee divided by 134.6 into 100, you will get 7.43 percentage. Okay, same thing. Now second one, selling price. Selling price 2.5% advance. Selling price, what we have to do? Selling price we have to reduce by 2.5 percentage. What is the selling price? 100. If I reduce 100, 2.5, 100 minus 2.5 percentage, how much I will get? 97.5. So nothing you do. Selling price per unit alone you change to 97.5. Then you recalculate everything. Okay, this is 97.5. Variable cost you keep it same. So selling price minus variable cost, this will become 47.5. Number of units you keep it same. So contribution into number of units, so you will get the total contribution. Okay, you will get the total contribution. Fixed cost you keep it same. So this net cash flow will changing. If net cash flows is changed, then present value of cash flows also changed. So you will get the NPV. This you keep it as 400. Okay, don't keep it 410. Keep it as 400. So you will get the percentage change in NPV. Same way, variable cost. Variable cost, what you have to do? You have to increase by 2.5 percentage. What is the variable cost? 50. So 50 plus 2.5 percentage. What is the amount? 52.5. So variable cost alone, you change it to 51.25. 50 plus 2.5 percentage. Yeah, 51.25. All other things you keep same. This alone you change. Okay, this alone you change. Variable cost alone you change. Then you recalculate and find out the NPV. Same way, fixed cost. Now fixed cost, what you have to do? You have to increase by 2.5 percentage. What is the fixed cost? 50 crore. So 50 crore plus 2.5 percentage. What will be your new fixed cost? Your new fixed cost will be 51.25. So 51.25 alone you change. All other you keep same. Okay, all other things you keep same. Okay, then you find out, okay, what is the NPV and percentage change in NPV. Same way, unit sold. Unit sold, what you have to do? You have to reduce it by 2.5 percentage. What is your unit sold? Actual unit sold 5 crore. So 5 crore, if you're reducing by 2.5 percentage, you will get 4.875. Okay, so unit sold alone you make it to 4.875. All other things you keep same. Okay, all other things you keep same. Then you will get the new NPV. Once you find out the percentage change in NPV, wherever the percentage is more, that is more sensitive. Now if you see here, this selling price is more sensitive, because once selling price is 10% adverse variance, your NPV has reduced to 24 percentage. Your NPV has reduced to 24 percentage. So selling price you have to take care, because selling price reducing is having a high impact, a high risk impact in in capital budgeting in NPV. So that is the reason what you have to do is that you have to write the answer as 24.82%. Okay, I'm not giving much explanation. I'm only providing the computational part, because once you do the computation, you will get the answers. Okay. Now the above table changed, they were changing one variable by at a time by 2.5% while keeping the others constant. The impact is seen. So the impact is maximum in NPV. Okay. You also write impact is minimum in here. Okay. That also you write, because that is also one more analysis. Then sensitivity analysis. This is very important. If in other technique they want to ask something, they can ask sensitivity analysis. Okay. They can ask sensitivity analysis. Now, two other techniques, both are very similar. One is certainty equivalent. Okay. Certainty equivalent. Second one is risk adjusted discount rate. Okay, risk adjusted discount rate. Okay, these are two other methods. I'm just giving you 50% chance statistical techniques will come. If other techniques are coming now, one scenario analysis is possible. Second, anything out of these two is possible. Okay, anything out of these two is possible. Now, what is certainty equivalent? I'll tell you one thing. Certainty equivalent is nothing. It is similar to expected value only. I will tell you how. But in expected value, probabilities are used. Here, probabilities are not used. Now, 4 years cash flows are given for 100, 300, 200, 80. Okay, 4 years cash flows are given. These cash flows are uncertain. Okay, these cash flows are uncertain. Okay, now you have to make this cash flow certain. So to make this cash flow certain, you are making some adjustment, which is certainty equivalent adjustment. So certainty equivalent value will be given. Suppose here certainty equivalent is 0.9, here it is 0.7, here it is 0.5, here it is 0.2. Now these are the certainty equivalent. So what this, now this will be certainty equivalent cash flows. Okay, this will be certainty equivalent cash flows. You multiply this will be 900. Okay, this will be 210, this will be 100, and this will be 16. Okay, this will be 16. Okay. So after calculating all that, you will get the certainty equivalent cash flow. This cash flow you discount and then you calculate NPV. This is what is certainty equivalent. See, cash flows are uncertain. So what you are doing, you are converting the uncertain cash flow to certain cash flow by multiplying a certainty equivalent factor. This is the first way. What is the second way? What is the second way of making the cash flow certain? Okay, but cash flow are uncertain. Okay, cash flow are uncertain, but discounting rate, 15% discounting rate is there now. I will add something called as risk premium. I will add something called as risk premium. What is risk premium? Okay, these cash flows are very uncertain. So when the cash flows are uncertain, you just add 4% risk premium that you have to make and make uncertain cash flow. But this is risk adjusted discounting rate. You discount this cash flow with the risk adjusted discounting rate, you will get the NPV. Okay, you will get the risk adjusted NPV. Okay, here I will just giving you one summary. Certainty equivalent and risk adjusted discounting rate. So here cash flows are adjusted with certainty equivalent factor and then NPV calculated. Here discounting rate is adjusted by adding risk premium and then NPV is calculated. Are you all understanding this thing? Are you all? Because whenever we see some new concept, certainty equivalent, people become very anxious. Yo, what is this? Very simple. Okay, certainty equivalent and risk analysis in capital budgeting. Just see one problem and you will get. Now see, these are the expected cash flow, certainty equivalent coefficient. Multiply that and then you will get certainty equivalent cash flows. Okay, certainty equivalent cash flow and this cash flows, you will get something, you multiply this, you will get, here you will get 9 lakhs, okay? This 15 lakh into 0.85. This value you multiply with present value factor. Once you multiply with present value factor, you will get. Always try to solve these problems in tabular format, okay? Don't solve this problem like this, because when you see this problem like this, your mind is not recognizing that you already know. Once you do the problem in tabular format, your mind will tell this thing I already know, only this is one special adjustment, okay? Only this is one special adjustment, is certainty equivalent coefficient. Now risk adjusted discounting rate is nothing. 1 minute, we'll see one problem. Risk adjusted discounting rate. This was the problem I was looking for. Only 3 factors are there. See, determine the risk adjusted net present value, okay? Risk adjusted net present value. Cash outlays are there, project life is there, annual cash flow is there, coefficient of variation is there. The company selects the risk adjusted rate of discount on the basis of coefficient of variation, okay? Now see, if the coefficient of variation is 1.2, what should be the risk adjusted discounting rate? 16%. See, when you see a big question, people, boggle their head. Ayyo, avlo number irukku, what you have to do? Nothing you have to do. You just first read the question, okay? What is happening? 1.2, 16% is the risk adjusted. So for X, at what rate you will discount? 16% rate you will discount. For Y, coefficient of variation is 0.8, 0.8 na 14%, you discount at the rate of 14%. Z, the coefficient of variation is 0.4, so you discount at the rate of 12%. Now discounting also present value factor already given, okay? Because all these are annual cash inflows. So 70,000 into 3.274, 42,000 into 3.433, 30,000 into this 3.605. Once you get this, you will get the present value of cash inflow minus present value of cash outflow. You will get something called as net discounted net present value. Now see this, 2,10,000. Okay, this is the coefficient of variation. This is the risk adjusted discounting rate. 70,000. What I said, 70,000 into 16%, 3.274. You will get the discounted cash inflow, and then you minus discounted cash outflow. You will get the risk adjusted net present value. Okay, very simple. Okay, never fear the problem just by seeing whether the problem is big or not. Once you read the problem, you will get everything. Okay? Now completed. Now this thing is completed. Okay, now everything is completed, all the techniques are completed. This is what is risk analysis in capital budgeting. Okay, risk analysis in capital budgeting. Now 2 more chapters I wanted to do. We can even do dividend decisions or ratios. Let us complete ratios, okay? Because ratios we don't have I don't have to explain anything, because ratio is completely practical. Only when you solve the problem you will understand ratios. How much ever formula, many people get scared because they will have some formula book in their hand. In that formula book, in this chapter alone, some 40-50 formulas they will write, and all those 40-50 formulas will be running in their mind, that they become confused, and with an insane mind they will go and write it the exam. That is not even a good approach. Okay, that is not even a good approach. When you analyze the problems or ratios, you only have to see only 2 types of ratios are very important. One is that turnover ratios, and second one is the profitability ratios. If you see this turnover ratios and profitability ratios, most of the problems, only these 2 ratios are used to do all the problems. Now when we come into ratio analysis, I won't give you all the formulas, all the information, and I will break your head. What I will give you is an approach how to solve the problem. Then in the Sundays class I will solve some good problems in ratio, because ratio, this is a problem revision. Okay, we cannot do a theory revision for ratios, but I will at least give you the approach of how to approach any problem, and some important formulas I will give you. Okay, some important formulas I will give you. Just one moment. Okay, pa. See, as I said, first in ratios, okay, one is the profitability ratios. Okay. Second one is the turnover based ratios. Okay. The turnover based ratios. Many names are given. I won't confuse you. This is also called efficiency ratio. This is also called activity ratio. I won't confuse. Turnover based ratio. Wherever times, turnover times is given, that is turnover based ratio. Profitability ratio, no profit. Okay. We have gross profit ratio, net profit ratio, and operating profit ratio. Okay, operating profit ratio. Very simple. Gross profit by sales into 100, net profit by sales into 100, operating profit by sales into 100. What is operating profit? Operating profit, many people get confused about. Operating profit means the profit from operations. Ayo, sir, very good. Profit from operations. How to calculate profit from operations? See, whenever you're having sales, okay, sales minus variable cost. So variable cost is an operating profit. So operating expenses alone you have to reduce. All this selling expenses, distribution expenses, this alone you don't have to minus. All the operating expenses alone you have to reduce. Okay, all the operating expenses you have to reduce. Okay, sales minus all the operating expenses. Okay, sales minus variable cost minus all the operating expenses is called operating profit. Okay, operating profit. Usually EBIT is equal to operating profit. Okay, but if we have any selling and distribution or any other like those fixed costs, you don't have to minus that. Okay, so these are the profitability ratios. Now, turnover ratios. I'm going in the order of importance. Asset turnover ratio. Asset turnover ratio. I will tell you one thing. What is turnover ratio? Whenever any turnover ratio is given, turnover ratio means the denominator. Okay, the rupee sales. Okay, rupee sales. Okay, how many rupee sales for 1 rupee of any denominator or any factor? Okay, how many? So if it is asset turnover ratio now, how many rupees of sales for 1 rupee of assets? 1 rupee of asset I'm investing now, how many sales I'm generating? Okay, it is sales generated for 1 rupee of asset. Okay, of 1 rupee of asset. If 1 rupee asset I'm putting, if I'm generating 2 times, if I'm generating 2 times of the say, if I'm generating 2 times, if my asset turnover ratio is 2 times now, for 1 rupee asset I'm generating 2 rupee sales per 1 into 2, I'm generating 2 rupee sales. If I'm investing 50,000 rupees in asset now, I'm getting 1 lakh rupees of sales. So that is what is asset turnover ratio. So how to calculate asset turnover ratio? Nothing. Okay, nothing. See, as I showed, my if I'm having my asset turnover ratio is 2 times, so if I'm investing 50,000 rupees, 1 lakh sales I'm generating, correct? So 1 lakh divided by 50,000, it is nothing but turnover divided by assets. Turnover divided by assets. Okay, total asset turnover ratio. Okay, total assets. Total asset. If opening, closing, all these values are given, then average assets. Okay, usually average assets will be there. Many questions average assets are not there, so I'm taking total assets. Okay, so asset turnover ratio, fixed asset turnover. So any asset turnover ratio, this is total asset turnover ratio. Okay, total asset turnover ratio, fixed asset turnover ratio. Any turnover ratio is given, you just have to calculate turnover divided that denominator. Okay, now these are the normal profitabilities: gross profit, net profit, and operating profit from a company's perspective. But we have some other ratios also. Okay, return on investment. Okay, return on investment. This is also one profit. Okay, this is also one profit. But return on investment, see, the return on investment is for whom? For equity and share, equity and long-term debt holders both, correct? So who is the what amount is there? I mean, what amount is available for both debt holder and equity holder? As I already said, in capital structure also I said EBIT is the amount. EBIT is the amount that is there for both debt holders also and equity shareholders also. So EBIT divided by investment. What is investment? The capital employed is the investment, correct? Capital employed is equal to equity share capital plus reserves and surplus plus all the long term, which means my investment, my equity shareholders investment plus my debt holders investment. What is equity shareholders investment? Equity share capital plus reserves and surplus. What is debt holders investments? Long-term debts. So these both have invested how many amount? So that is called capital employed. Whenever capital employed is there, now it is not equity capital. Capital na long term. So what is long term capital? One is my long term capital, another one is equity capital. Okay. So capital employed. Capital employed. Now what is the total amount for on which the business is running? On which the business is running. The business will not run with own money only. The business will run with outside money also. Capital employed is nothing but own money plus outside money. Okay, plus outside money. Long term. Okay, long term, not short term. Long term. So EBIT divided by capital employed. Return on investment, return on investment for both. Okay, return on investment, return on investment for both. If I'm putting return on equity, okay, if I'm having a return on equity, then what is the amount available for equity shareholders? What is the amount available for equity shareholders alone? You have to put, okay, earnings available to equity shareholders. Earnings available to equity shareholders. Why earnings? Why I didn't put PAT? What if there is a preference dividend? Okay? What if there is a preference dividend? So I'm directly putting earnings available to equity shareholders divided by what funds? Capital employed. No, equity shareholders funds. Equity shareholder funds. Correct. Equity shareholder funds, the equity shares plus reserves and surplus. Don't get confused. Here only people get confused. Return on investment, return on equity, return on net worth, return on total assets. In this, people will get confused. Return on investment, you're doing EBIT by capital employed. Return on equity, now why not divided by capital employed? Because the profit is of equity shareholders, the numerator is for equity shareholders, so denominator is also for equity shareholders. Return on investment, the numerator is for both equity shareholders and long-term debts, so denominator is also including equity shareholders and long-term debt. Okay, so that is the reason return on investment is equal to EBIT divided by capital employed. Return on equity is equal to earnings available to equity shareholders divided by equity shareholder funds. Okay, equity shareholder funds. Now return on, let's put, I'm just taking all the confusing and tricky parts where people get stuck. Okay, let's put return on net worth. Okay, return on net worth. What is net worth? What is net worth? The shareholder funds, correct? The shareholder funds is alone net worth. People say capital employed, net worth, whatever you put. Okay, it is PAT, profit after tax. Okay, earnings after tax divided by my shareholder funds. Okay, my shareholder funds, my shareholder funds. Now, yeah, return on total assets is very simple. Return on total assets is equal to PAT divided by total assets. PAT divided by total assets. Okay. Now you all will be asking why you are putting here PAT shareholder funds. Why you are putting here shareholder funds and not capital employed? Because here preference share capital will also get included. Okay, preference share capital will also be included. Will also be included because he is also a shareholder. So here all the shareholders, equity shareholder is included, long-term debt funds are also included, and this preference share capital, that is also included. Okay. And when I say capital employed, equity share capital plus preference share capital. But when I say capital employed, it will be equity share capital plus preference share capital plus debt capital plus debt capital. Okay, plus debt capital. Okay. Now, I hope I'm not confusing you, and I hope there is clarity in ratios. Okay, there is clarity in ratios, because ratios is the only chapter where more confusions are there, because different ways different problems are solved. Okay, In the same material, one way for this formula, some other values are used, another formula, some other values are used. So it is nothing, okay? It is nothing. Even if you're using some other formula, it is not wrong, because even in the suggested answer, 1 or 2 alternatives are given. Because even in the study material, there are more than one ways of solving a problem. Okay, more than one way of solving the problem. So don't break your head on which is correct, which is not correct. Somewhere this value is added, somewhere this value is reduced. Understand the logic and do. Okay, understand the logic and do. Okay, now one more thing, people get confused. One more confusing ratio is people think interest coverage ratio. They don't understand this interest coverage ratio. This is also many times it is used in exam. It is asked. I'm just going into the order of importance. Interest coverage ratio. Na, out of my earnings, how much time I can pay out the interest? That is what is interest coverage ratio. My earnings, how much of my earnings is covered? Covered for paying my interest. It is nothing but EBIT divided by interest. Okay, EBIT divided by interest. Suppose I'm having an interest of, I'm having an earning of 1 crore rupees. Out of those 1 crore rupees, I have to pay interest of 20 lakh rupees. So I can say that I am having 5 times more money, because 100 divided by 20. I am having 5 times more money. So interest coverage ratio is 5. I am having 5 times more money to pay off the interest. So that is what is interest coverage ratio. EBIT divided by interest. EBIT divided by interest. Ratios and analysis are used for decision making. Okay. So under final level, you will have good discussion on ratios and analysis. Inter level only calculation computation parts are tested. When we talk about problems, what are the 2 types of problems? There are only 2 types of problems that can be asked in ratios. One is they will give details. Okay, details will be given and ask us to calculate the ratio. Ask us to calculate the ratios. Second type of problem is that partial detail and few ratios given, and they will ask us to construct income statement or and balance sheet. Only 2 types of problems are possible in ratios. Okay, this becomes the easy one, this becomes little challenging. Here approach is required. Okay, here formula for knowing the formula is required. Here approach is required, and here knowledge of formula is required. Sir, which is usually asked in exam? Usually this is asked in exam. Okay, usually this is asked in exam. Now what approach? What is the approach that you have to follow? What is the approach that we have to follow? Okay, now see, I'm talking about this thing. Okay, first thing we already discussed. I'm talking about now second thing. In ratios problem, okay, in ratios problem, first thing is you will be given a few ratios. Say you have given asset turnover ratio. I'm just framing a question. Okay, asset turnover ratio is given. Okay, something is given. Okay, 10 is okay, 10 times. Asset turnover ratio is given. Say inventory turnover is given. Okay, 5 times. Okay, inventory turnover is given. Now for this I want asset and turnover. For this I need inventory and turnover. So if I have turnover with me, I can easily calculate assets and inventory. Correct? I can easily find out assets and inventory. So I have to find somewhere turnover. How will I find out turnover? You have to identify. Then somewhere gross profit ratio will be given. Okay, somewhere gross profit ratio will be given. Say gross profit ratio is 35%. This is also gross profit divided by sales into 100. Okay. Okay. So gross profit, and somewhere gross profit amount will be given. Okay. Say the gross profit amount is 1 lakh rupees. Okay. Somewhere gross profit amount is given. Using this gross profit amount, you can calculate the gross profit ratio. Correct? Because gross profit is 1 lakh. 1 lakh divided by sales is equal to 35%. So sales is equal to 1 lakh divided by 35%. Okay, 1 lakh divided by 35%. Okay, so you got sales is equal to 2,85,714 summa. Okay, I'm just now only I'm framing the question. So now you got sales is equal to 2,85,700 rupees, something you got. Now using this sales, you can find out assets, you can find out inventory, and then you can construct the balance sheet. Okay, so whenever you're reading any problem like this, okay, whenever you're reading any problem like this, first you have to see what and what is linked. Okay, what and what is linked, what is given. Okay, what is given. Now here you just have to go backwards. Gross profit is given. If gross profit is given, where I can use this gross profit formula? Some amount is given. Now first you have to see this amount where I can insert. If you can insert this amount in gross profit, what you will get? Sales I will get. If I insert the sales in this, I will get inventory. If I insert inventory in asset, I will get assets. I'll get inventory. That is how will the approach. Always the approach will be always the approach for solving the problem. Okay, the approach for solving ratios problem will be, first identify numbers given. Okay, numbers given. Wherever numbers are given, you just see. Suppose sales amount is given. Okay, suppose sales amount is given, or suppose profit amount is given. Okay, or suppose say inventory amount is given. Any amount is given. First you identify what are all the numbers are given. Okay, what are all the numbers are given. Okay, first you identify what are all the numbers are given. Second, identify in which formulas those numbers can be used. Okay, now suppose you have inventory with you. Okay, suppose you have inventory with you. So you know that this inventory can be used in inventory turnover ratio, or this inventory you can use in the conversion period formula. So few formulas you can use inventory. So see, if inventory turnover ratio is given, suppose if inventory turnover ratio is given, okay, inventory turnover ratio is given, you will identify this inventory number can be used in inventory turnover ratio. Okay, so just directly put this, should be a first step. Directly put this and then you find out. Okay, I'm just giving an approach. Third step, okay, if directly identifiable. I will tell you what is the second if directly not if directly identifiable. Okay, if directly identifiable, calculate the resulting number. Okay, calculate the resulting number. I'm just giving an approach. If you think this way, solving the problem becomes easy. Okay, step by step approach. If directly identifiable, calculate the resulting number. Okay, calculate the resulting number. Now if you calculated, if you have inventory, you identify that inventory can be used in all the ratios given. Inventory can be used in inventory turnover ratio. Okay, then because it is directly identified, calculate the resulting number. What will be the resulting number? The resulting number will be turnover. Don't calculate C. Okay, see what will be the resulting number. Okay, turnover. Okay, and then repeat same thing for resulting number. Now you got the turnover. Now see where these turnovers can be used. Now fixed asset turnover will be given, this turnover will be given, gross profit ratio will be given, net profit ratio will be given, everywhere turnover will be used. So all these things you can be calculated from turnover, and 90% of the time your problem will be solved in this way. 90% of the time your problem will be, okay, repeat with resulting number, okay, till answer is solved. Till answer is solved. Now if you are not able to directly identify, okay, if not directly identified, okay, if not directly identified, then you have to define a variable. Then you have to define a variable X. You have to define a variable. 10% of the times this type of problems will come. 90% of the time the problem will be solved in this way only. Okay, few problems only you have to define a variable x, and using that x you have to construct a balance sheet, and then you have to find out all the things. Okay, very rare these problems are there, like 10%, like out of 10 one problem will be there, okay, like this. But I'm just giving you an approach how to do. If not directly identifiable now, you have to keep a variable x. What you have to keep? Any number which is used a lot of time. Usually sales is kept as yes, x, or profit is kept as where everywhere that value is used, that amount is kept as x. Okay, so here this problem I will solve in Sunday's class. In Sunday's class I will solve one good problem in this and also in this way. So this is how problems are solved in ratios and analysis. Okay, so I'll complete ratios and analysis. I know that you will not be satisfied with this, because it is a practical chapter. Only by solving the problem and practicing alone you will be able to. Otherwise, my value addition is only by giving an approach and by giving some points which are actually very important and very crisp points that I have to give. So these are all the crisp points that I have to give: the return, the confusion in all the returns, and then few important ratios. Okay, few important ratios. Yeah, collection period. Okay, collection period and payables period. Many people will have this confusion. What is average collection period? Okay, average collection period. Many people will have a this. Average collection period is equal to 1 minute. Average collection period is equal to average receivables divided by average sales per day. Divided by average sales per day. 1 minute. Let me confirm. 1 minute. Because many a times topics like this have 2-3 formulas. Let's see. Correct. Average receivables divided by average sales. Okay, credit sales. It will be credit sales. Okay, average credit sales per day. What is average credit sales per day? Total credit sales divided by number of days. Okay, total credit sales divided by number of days. Okay, so this is what is the formula for average collection period. Okay, we also have, because average collection you have to do for creditor, sorry, debtor. Collection you have to do for debtor. Okay, so this is for debtor. So we also have debtor turnover ratio. Okay, debtor or receivable turnover ratio. Receivable or debtor turnover ratio. We have a link between these two. Okay, debtor turnover ratio. Debtor turnover ratio is nothing but out of all the sales, how much is my receivables. So out of all my credit sales, so credit sales divided by average receivables. Okay, credit sales divided by average receivables. Suppose I sold goods worth of 1 crore rupees. Out of those 1 crore rupees, suppose 10 lakh are receivables. So I can say out of those 1 crore rupees, if 10 lakhs, so I can say 10 times if my debtor turnover ratio. 10 times is my debtor turnover ratio. For 1 rupee of debt, I am able to generate 10 rupee of sales. Is what is receivable turnover ratio. I already said turnover ratio, not turnover numerator. Okay, mostly you see here all the turnover ratios, total asset turnover ratio or fixed asset turnover ratio, inventory turnover ratio. Few places cost of goods also will be used. It is always based on questions. Okay, it is always based on question. You have to see the question, then you have to solve it. So receivable turnover ratio is equal to credit sales divided by average receivables. Okay, credit sales divided by average receivables. Now if you see here, credit sales per day. What is credit sales per day? Credit sales per day is equal to credit sales divided by, say, if days are given. Usually you don't put 365 days. Some questions 360 days are given. Okay, I'm just putting 365 days. If nothing is given, then use 365 days. Okay, if nothing is given, then you use 365 days. But usually in the question it will be given. Okay, usually in the question all these values will be given. $360, sorry. Okay, 360 days is the normal time we are taking. Now average credit sales divided by 360 days. Now here credit sales divided by average receivables. So one more formula for average collection period can be 360 days divided by receivable turnover ratio. I can also say 360 days divided by receivable turnover ratio. I'm confusing it now, but why I'm confusing it now is that only one formula you have to remember. Okay, all other formula you can link it. Okay, you don't have to memorize all the formula. One formula you remember. Okay, one formula you remember. Based on this formula, you try to link 5 to 6 formulas. Now turnover ratios. You just remember one turnover ratio. Say asset turnover ratio, which is turnover divided by total asset. Then through that you try to link 4 or 5 ratios, and by this you create a map in your mind. It is very risky to mug up all the formulas. Okay, it is very risky to mug up all the formulas. The only way to gain confidence in ratio is by solving problems. Okay, so what else we can do in ratios? 1 minute. Okay, I think this will be enough for ratios. For revision perspective, this will be enough. Okay. Okay. Now let us go for dividend decisions. See, yesterday, actually now module 1 is fully completed. Okay. Module 1 is fully completed. Module 2 also, 2 big chapters, capital budgeting, risk analysis and capital budgeting is completed. Now what we are doing is dividend decisions. Then only we have one more chapter. Which is management of working capital. Management of working capital will not be feasible to do in today's class. Okay, management of working capital, because I already said you management of working capital, ratios and capital budgeting, all the three are practical problems. I mean all the three are practical chapters. Everything is practical chapter, but these 3 chapters requires good practice. Okay, these 3 chapters require good practice, but management of working capital, I'll give you an approach. Okay, I'll give you an approach. We won't be going in-depth discussion like how we did in capital budgeting and cost of capital. But what I will do is I will give you an approach. Now let us go for dividend decisions. Okay, let us go for dividend decisions. I will go in the order of importance. I will go in the order of importance. Dividend decision, very important chapter. Definitely one question will come. I will tell you that also. I will tell you what question will come. Okay. First chance of question is Walter and Gordon. Okay, Walter and Gordon. This is 50% chance Walter and Gordon can be asked. Okay. We have two formulas in dividend decisions. Two formulas for finding price. Okay, P0. Two formulas are there to find the price. One is Walter's model. Okay, Walter's model. Second is Gordon's model. Second is Gordon's model. Both gave their own formula for price. Okay, both gave their own formula for price. Walter's model and Gordon's model. Dividend decision, I'm telling you, in dividend decision, okay, in dividend decision, very important is Walters and Gordon. Okay, and then you have some traditional methods, this Graham and Dodd model, and then we have Linter's model. This formulas are very simple. Okay, so there are high chances that questions can also be asked. Okay, that have been rarely asked, but if it is asked, now no one will be able to answer because many people don't study Linter's model and Graham and Dodd model. But for a change, we will discuss that. Okay, we will discuss that. So first we'll go into order of importance. First, dividend decision, Walter's model. Okay, dividend decision, Walter's model. The formula for Walter's model is T plus R by K into E minus D the whole divided by K. Okay, Gordon, let me discuss subsequently. So this is the formula. You want to mug up the formula, you want the logic. Okay, everyone, we have to study logically only. We don't have to mug up the formula, but it is not feasible to tell the full logic. But I will tell you the an approach. I will tell you a small idea. What is this formula? We studied price formula. Okay, price formula, we already know five types of KE we studied, correct? Under cost of capital, KE, 5 formulas we studied. You all can remember those 5 formulas. Just a revision. You all can remember those KE formulas. KE formulas, okay? Constant dividend. You are able to recall constant dividend, constant earnings, dividend growth model. Are you all recalling this? Dividend growth model. Okay. We have CAPM model. What is KE? What is KE? Constant dividend. DPS by MPS. What is KE here? EPS by MPS. What is KE here? D1 by PO plus G. Are you all able to recall? Are you all able to recalling this? What is KE here? Risk-free rate plus beta into RM minus RF. Okay. MPS is nothing but PO. Okay. What is market price per share? What is PO? PO na price of today. What is today's price? Today's price is MPS. Okay. MPS is nothing but PO. Are you all able to recall? See, again, this is very important. Okay. This is very important. I already told you, usually in these 3 only questions are asked if KE question is asked. Now, just again I'm revising this. Okay, again I'm revising this. Very important. Constant dividend approach, constant earnings approach, dividend growth model, CAPM. There we calculated KE. Okay, there we calculated KE. But if you want to calculate P, how can you calculate? If you want to calculate P, how will you calculate? So this will be P is equal to what? DPS divided by KE. Correct. If I want to write PO, how will you do? EPS divided by KE. Nothing pa. This PO I'm bringing here, KE I'm bringing down. If I want to find PO here, what I will do? If I want to find PO here, what I will do? It is D1 divided by KE minus G. How, sir? You do the calculation and then you see. Okay, you will get this only. If you bring G here, it will become KE minus G. Okay, Ke, if you're bringing G here, it will become K minus G. And then K minus G, D1 is there. So D1, K minus G, PO you brought here. Are you all getting this? No, let me show this, okay. Ke minus G is equal to D1 divided by PO. PO you are bringing here. So PO is equal to D1 divided by K minus G. Okay. So these are the formula. Okay. From here, price is not there. So okay. So CAPM alone. So we saw 3 price formulas there. Okay. Now this is one more price formula. This is one more price formula which Walters is given. Now Walter is giving one more formula for price. This is also one price formula. This is also one price formula. This is also one price formula. What Walter is telling, this is my price formula. Now what is happening here? Okay, what is happening here? What is Walter is telling? He is using this logic, constant dividend approach only. What he is telling, this d by k, this is nothing but d by k plus r by k into e minus d by k. So d by k plus r by k into e minus d by k. This is what is this, correct? This is what is this. What he is telling, this d by k I'm accepting. Okay, dividend I'm getting is I'm expecting. Okay, I accept this. Okay, d by k I accept. But after giving dividend, I will be having some retained earnings, correct? Suppose my earning is 100 rupees, I gave 50 rupees dividend, I am having some 50 rupees, right? I am having some 50 rupees. So that is what is telling E minus D. This should also be included in price formula, na? So what he is telling is, I'm just explaining his brain, okay? One is this dividend I'm getting, okay? This present value of dividend, D by K is present value of dividend, cash flow divided by R, perpetuity, okay? Present value of dividend, okay? D by K is okay. So now E minus D. On this E minus D, this 50 rupees retained earnings, I'll be earning some return on investment, right? I'll be earning some return, okay? On this E minus D, I will be earning some return. This return every year I will earn, correct? This return every year I will be earning. So that is the reason I'm doing KE. That is the reason I'm doing KE. And this, the present value of this amount is divided, the whole divided by KE. So that is the reason here K is divided 2 times. I won't explain again. This is, just a logic, okay? Don't, try to go very deep into it. This is what the logic, okay? This is the dividend. This is the dividend. This is the present value of dividend. And this is the present value of retained earnings. According to Walter, okay? According to Walter, by this only this formula came. So what is the formula for Walter? If you see the formula for Walter, P0 is equal to, first is D by KE. Okay, D by K is okay. Plus retain earnings. What is retain earnings? E minus D is retain earnings. Okay. On this retain earnings, I'll be earning some income, which is into R. Total retain earnings I won't get. On this retain earnings, I'll be earning something called as R. And the present value of this R, because this R I'll be earning every year. The present value of this I will divide it by KE. I will divide it by K, and this is the whole divided by K. This is what is the formula for Walter. Okay, this is what is the formula for Walter. Let's write it again. P0 is equal to D plus R by K into E minus D, the whole divided by KE. Okay, formula for Walter. Why I'm writing again and again? So that it should go into your brain. It should go into your brain. Okay, you should not forget the formula in exam. P0 is equal to D plus R by K into E minus D. How you have to, first is dividend, this is retained earnings. Okay, just a logical way. This is Walter's formula. What is R? R is the return on investment or IRR. K is cost of capital. E is earnings, EPS. D is dividend, DPS. Okay, earnings per share, dividend per share. Okay, K is cost of capital. Okay, K is cost of equity. Okay, cost of capital or cost of equity. Okay, what is R? R is return on investment or IRR. Okay, return on investment or IRR. Done. This is one formula for Walter. Walter's formula is okay. Now, let us go for Gordon's formula. Let us go for Gordon's model. Now, let us see what Gordon is telling. Okay, let us see what Gordon is telling. How Gordon is starting this formula is E. Okay, how Gordon is starting is E. E. But first year earnings, okay, E1 into 1 minus B divided by KE minus B into R. Okay, this is the formula for Gordon. Sir, everyone is giving different price formula. I'm getting very confused. Don't get confused. Okay, first thing is you have to remember this. You have to remember these three. Okay, K ka 5 formula you have to remember. If you know the K is 5 formula, you will be able to easily derive the logic here. So this is nothing but this is the logic that we derived from constant dividend. Now this is the logic that we will derive from dividend growth model. What was the formula for dividend growth model? Dividend growth model, what is the formula? D1 divided by K minus G. Yes or no? D1 divided by K minus G. Okay. What is D? What is dividend? What is dividend? B is equal to retention ratio. Okay. B is equal to retention ratio. Correct. B is equal to retention ratio. So 1 minus B is equal to dividend ratio. Correct. See, if I'm earning 100 rupees, if I'm telling 60% is retained, which means 40% is distributed. Correct. Which means 40% is distributed. So 1 minus B, if B is equal to 60%, then 1 minus B is equal to 40%. I hope I'm making sense. B is equal to 60%, then 1 minus B is equal to 40%. So if I want to find the dividend, what I will do, earnings, okay, D1 na E1 I'm writing, my first year earnings into 1 minus B is nothing but D1. Is nothing but D1. Okay, B is equal to retention ratio. E1 into 1 minus B is nothing. Sir, why they are doing like this? E1 indirectly they can write now E1 into dividend ratio. No, why they are writing B? I will tell you the logic. Okay, why? Because B is used again. So that is the reason they linked this also with B. So this is nothing but this is earnings. Okay, this is earnings, and this is dividend payout. Okay, this is earnings. This is dividend payout. If you put earnings into dividend payout, you will get D1. Okay. Now, K minus, you already know G is equal to B into R. In capital structure also I told you, right? In capital structure I told you G is equal to B into R. G is equal to B into R. Where we used in dividend growth model also, I said G is equal to B into R. Now how G is equal to B into R? See how growth is calculated. If whatever I'm earning, directly everything I'm giving to shareholders, how I will grow? I cannot grow, correct? 100 rupees I earned, 100 rupees I gave to shareholders. So I didn't reinvest anything. So how will I grow? Reinvestment is only growth, correct? So B is equal to retained. B is equal to retained. On this retained earnings, how much is I'm earning will become my growth. Okay, this is just a small petty logic for you to understand. But this is how the formula is made. The formula is made from dividend growth model. Okay, the Gordon's formula, you just remember GG. Gordon's formula came from growth model. Gordon. When you read Gordon, why I'm telling all this is in exam, you will not be able to remember. Okay, so G, Gordon, growth model. Okay, growth model, but don't directly write the growth model. His formula is E1 into 1 minus B, because D1 divided by K minus D. So E1 into 1 minus D divided by K minus B into R. Okay, K minus B into R. A minus B into R. This is what the formula is. I'm giving you the logic. Otherwise, you can even memorize the formula if you want. Okay. Gordon's model. Gordon's is telling the growth model. Walter was also putting growth here. So Walter has put growth in a different way. Okay. Walter has put growth in a different way. He has put growth in this way, that he has put growth in denominator. Okay. So this is what it is. Walter's model and Gordon's model. Again, just for revision sake, what is Walter's model? You also tell. Okay, you also tell, so that you will also get to know what is Walter's model. You have to calculate the price. What is Walter's model? Okay, Walter's model is first dividend plus D divided by K is very common. Okay, first dividend, then E minus D, retained earnings, R by K. Simple. E minus D, R by K. Now, Gordon's model. What is Gordon's formula? What is Gordon's formula? Actually, in the mind, you should come D1 divided by K minus G. But how it will come here? D1 na, you have to put from E1. E1 into 1 minus V. Divided by K minus G. So K minus B into R. K minus B into R. Walter's model, Gordon's model. Under dividend decisions, 50% chance the question asked from Walter or Gordon. Okay, the questions are asked from Walter or Gordon. Let's see dividend decisions. And nothing to explain. Know the formula, plug in the numbers, get the answers. I just told you the formula. Decision I will tell you now. Okay. Now see, earns 10 rupee per share. XY Limited earns 10 rupee per share. So this is E. Capitalization rate. Okay. Capitalization rate na KE. Return on investment na R. Okay. Return on investment na R. Determine the optimum dividend payout ratio. Okay. Since R is more than K, optimum. I'll tell you what is optimum dividend payout ratio. But if you see the formula, D1 plus R by K into E minus D, you just have to find out the price. You just have to find out the price. Now see this. Net profit. Preference shares, equity shares, return on investment. So this is R. Cost of capital. This is K. Okay. Net profit is the earnings. Net profit is the earnings. Okay. This is the earnings. Outstanding 12% preference shares. Compute the approximate dividend payout ratio so as to keep the price at 42 rupees. So if you see, you have to find out the earnings available to equity shareholders. From earnings available to equity shareholders only, you have to find out the dividend payout ratio. So here directly P0 value is given. Okay, P0 value is given, and they are asking you to find out D. Okay, they are asking you to find out D. Okay, K plus E minus D into R by K. E you have, R you have, K you have, P you have. You just have to find out D. See, write this formula. D alone we have to find out, put all the values. This is 42. Okay, this is 42. Directly it is given. This is 42. 0.2, 0.16. Okay, 0.2, 0.16. You have to find out earnings available to equity shareholders. Nothing but net profit minus preference dividend, earnings and earnings per share. Okay, earnings per share, number of equity shares. So earnings per share, EPS. What is EPS? 6. Once you put all the values, you will get the dividend payout ratio. It is nothing but the dividend per share. Okay, dividend per share is 3.12. Dividend per share is 3.12. Now, once you got the dividend per share, you can find out the dividend payout ratio. 3.12 dividend is declared from earnings. So from EPS of 6 rupees, if 3.12 dividend is that, then what is the dividend payout ratio? It is 3.12 divided by 6 into 100. You will get 52% is the dividend payout ratio. Same thing, Gordon model is also same. Okay, Gordon model is also same. They'll just give you the numbers, and with all this dividend payout ratio, you have to find out the P0. Okay, E1 is given as 6, K is given as 16. D is what is where the dividend payout is 25%, when the dividend payout is 50. When the dividend. So these two formulas, once you remember, you will be able to solve this problem. Okay. So now, in the next, I think we'll just take a 15 minutes break. Okay, we'll take a 15 minutes break. Right now the time is 3:45. We'll meet at 4 o'clock. And in 4 o'clock we will, after 4 o'clock we will complete the entire dividend chapter. This dividend I will make some more discussions. Okay, some more discussions I'll make. I will also teach this Graham and Dodd model, Linter's model, MM approach also I will teach you. Okay. and then we'll close this. Yeah, and then I'll give you some approach for this working capital management. I will just give you how to approach. Okay, I mean approach, and I will just tell you what you have to study first and what you have to study subsequently. Okay, for you to have a concentrated learning. So if there are any other doubts, you can put it in the chat box. By the time we are having the break, you can just put it in the chat box. I'll just will resume at 4 o'clock, and then I will take up all the doubts. Okay, I'll take up all the doubts. So I'll keep the last 15, 20, 25 minutes. I'll keep it free for doubts if at all we are having, and then we'll close this session. Okay, so let's have a 15 minutes break, and then we'll come back at 4 o'clock. Sure. So 4 o'clock, you all be here. 4 o'clock, I'll continue again. Okay. Good evening. Good evening. Okay. So we are coming close, to the end of this revision, and successfully we have completed many chapters. We have gone through many chapters, many topics we discussed. Some topics in depth we discussed. Some topics I gave you the approach. Some topics I only discussed the crisp points, and to the extent possible, at least I think that I did justice to the subject like FM. At least I think that. Okay. Now I just got a doubt where this problem revision class is happening. I already said you DM me. I will send you the details. So it is happening in Chennai only. It is happening in Chennai Royapeta, and I have the Google link also that I can share with you. Okay. So now we are discussing Gordon's and Walter's model. Okay. Now, as I said you, as a manager, we have to take dividend. As a manager, we have to take decisions. Two decisions already discussed: financing decision, investment decision. Now this is dividend decision. What is the use of finding the price? What is the use of finding the price? With price, what decision you will take? This question you all will ask, right? Now we have to take decisions, correct? Now the decisions according to Walter and according to Gordon. Okay, according to Walter and according to Gordon, both are saying the optimum. There we saw what is the optimum capital structure, what is optimum this. Now what is the optimum dividend payout ratio? Okay, optimum dividend payout ratio. Both are using R and K. Okay. R is the return, K is the cost. Okay, R is the return, K is the cost. Now, according to Walter and according to Gordon, what is the optimum dividend payout ratio? If the return that you're earning is more than the cost, what is KE? K is the cost. Okay, K is the expectation of the shareholders. The expectation of the shareholders. Suppose the shareholders are expecting 10%, but in my business I'm getting 15%. Okay, so don't give any dividend. Okay, don't give any dividend. The optimum payout ratio. Okay, optimum payout ratio is 0%. Okay, optimum payout ratio is 0%. Don't give any dividend. If R is more than K, don't give any dividend. Okay, R is equal to K, any percentage. Okay, anything you give, it is optimum only. If R is equal to K, whether anything you give, it is indifferent. Now if R is less than K, okay, if R is less than K, suppose the return that I'm earning is 15%, but the shareholders are expecting 20%. What you have to do? 100% pay. Okay, 100%. What is the optimum payout ratio? See, if I give to shareholders have something in which they're earning 20 rupees. That is why they're expecting 20 rupees. So shareholders are, so what you do, because you're earning only 15%. If you're retaining 1 rupee also, your share price will drop. Okay, if you're retaining 1 rupee also, share price will drop because it will be against the shareholders expectation. So 100% dividend payout ratio, all extreme only. Okay, all extreme only. See, what is the optimum dividend payout ratio? If R is more than K, it is 0%, because the return that you're earning is more than what is the cost. So don't give anything. You earn return. Okay, you earn return, and then you increase the value of the shareholders. If R is equal to K, then any percentage. If R is less than K, then 100% dividend payout ratio. Why? Because here shareholders will be happy. Shareholders are expecting 10%, but you are having a project which is giving them 15%. So if you don't give any dividend, okay, if the payout is 0%, payout is 0%. This is not dividend person. This is dividend payout ratio. Don't give any dividend. 100% if you're retaining, now shareholders will be happy, your price will increase. Okay, shareholder will be happy and your price will increase. So this is what is optimum dividend payout ratio. Okay, optimum dividend payout ratio. Two formulas. Now two more formulas. So these are less important. These are traditional formulas. Okay. Now both these cases, time value of money is used. You'll be thinking where time value of money, wherever divide by k is there, it is perpetuity. Okay, it is cash flow perpetuity. So it is the discounted cash flow. Perpetuity cash flow discounting is what we are doing divided by k. So all these cash flows are used. Traditional method, cash flow, time value of money will not be used. Okay. Now traditional method, we have two formulas. Okay, two more persons are there. One is Graham and Dodd model. Okay, Graham and Dodd model. Second one is Linter's model. Okay, Linter's model. I'll tell you according to Graham and Dodd. According to Graham and Dodd. Okay, according to Graham and Dodd, dividend whatever we are paying. Okay, dividend is having high weight and earnings is having less weight. Okay, earnings is having less weight. Why am I telling all this? Just for you to understand this formula. Okay, now the formula is D, dividend. Okay, that will be included in my price. Okay, then earnings I will do divided by 3. Why you are dividing by 3? No logic. Earnings we have to reduce the weight. So earnings, what I'm doing into 1 by 3. Dividend is 100%. So earnings I'm putting only 33% weight. So D plus E by 3 into a multiplier. Okay, a multiplier. Here I cannot do any discounting. This divided by k. So what I'm doing, I'm multiplier into some multiplier. That is my price. Okay, that is my price. What is this multiplier and all? Okay, no explanations given. This is the formula. But for just simple bare logic, if you want to know, dividend is giving more weight, earnings is given less weight. So D plus E by 3 into multiplier is what is the formula for Graham and Dodd. Okay, Graham and Dodd. Now Linter's model. See what Linter is telling. What Linter is telling. Current dividend. Okay. Current dividend is current dividend is actually connected with. So current dividend is based on previous dividend. Is based on previous dividend. Okay. Current dividend is based. I mean it is dependent. Okay. Based is not the right word. It is dependent on previous dividend. Okay. It is dependent on previous dividend. So what Linter is telling, is that according to Linter's is, see, whatever shareholders is like, if today you gave 2 rupee dividend now, next year definitely you should give more than 2 rupees. This is what is Linter is thinking. Okay. If today you are having 2 rupee dividend now, next year definitely you do something and give more than 2 rupees. If you are giving less than 2 rupees, if you are giving 1.5 rupee now, shareholder will think that something wrong is happening and your price will be reduced. Okay. So according to him, the current dividend is dependent on previous dividend. Okay. The current dividend is dependent on previous dividend. But what if I'm not having earning, or what if my earnings is very more? So current dividend is dependent on previous dividend and current year earnings. Okay. And current year earnings. And current earnings. Okay. And current earnings. Now I'll tell you the formula. Okay, this is one sentence. Okay, this is one sentence. But what is the formula? What is the formula? See D1. D1, what is D1 expected dividend? Next year's dividend. D1 is equal to D0. Okay. D0. This is so you should give. Okay. Now what extra you will give is dependent on current year earning. What extra you will give is dependent on current year earning. Okay. What extra you give is dependent on current year earning. Now, what is the extra amount that you give? One is the EPS. Now here it is. Now here what you're telling, because They are giving dividend, right? So every time they are having some target ratio. Okay, they will having some target ratio, some target payout ratio. Target payout ratio. What is target payout ratio? At least 70% dividend I will give. At least 80% dividend I will give, like this. Of 1 rupee earning, at least 80% I will give every. So in Linter's model, they have something called as target payout ratio. So last year dividend I will give. Okay, that dividend I will give. Now current year I will have something called as EPS into target payout ratio. Correct? Target payout ratio. Target payout ratio. This is extra I will give. This is not extra. Okay. Then this will become double counting. Correct? These zero I have already added. This is I will give. Then EPS into target payout ratio should be my current year dividend. Okay. But I want to find out the extra dividend. So what I will do, minus D0. Minus D0. I will explain you in some way. Just listen to me for some time, and then I will explain you what is happening. Okay. What is happening now? Into an adjustment factor. Into adjustment factor. Now listen to me. This is last year's dividend or current year's dividend. Okay, current dividend. Okay, current year's dividend. Current dividend. This is extra dividend based on earnings. Okay, extra dividend based on current earnings. Based on current earnings. I'm not trying to confuse you. Just understand the logic once. If you're able to remember the logic, well and good. If you're not able to remember the logic, remember the formula. Okay, not a great deal. Now see D1. Okay, D1. My dividend is based on, first thing is definitely I should give whatever I gave in the last dividend, that I have to give. Okay, currently how much I should give? Okay, pa, that is depending how much you have earned. Okay, sir, I have earned 100 rupees. I want 100 rupees. 100 rupees. Usually what is your target? Targetly how much you will pay? 50% of the dividend usually I pay. Okay, so 50 rupees you will pay today, right? But definitely last year how much you paid? See, last year I paid 30 rupees. Last year I paid 30 rupees. Okay, last year I paid 30 rupees. Okay, 30 rupees so definitely you will pay. 30 rupees definitely you will pay. Okay, so how much you will pay? How much you will pay? 30 plus what? How much you will pay? Okay, pa, what is your earnings? 100 rupees is my earnings. 100 rupees is your earnings. Very good. Very good. So target how much you will pay. Target how much is your target? Usually what is the percentage of EPS that you will pay as dividend? See, usually 50% of whatever I will earn, I will pay as dividend. Okay, usually 50% of whatever I will earn, I will pay as dividend. Okay, pa. So 100 rupees is your earnings. 50% is the target payout ratio. Okay, 100 rupees is your earning. Okay, last time you paid 30. 100 rupees is your earnings. So 50% is what you will pay. Okay, so 50 rupees should be your dividend, right? 50 rupees is your dividend. Okay, 50 rupees is your dividend. So if I'm not having any adjustment factor, now 50 minus 30 plus 30. So 50 rupees I will pay. EPS into target payout ratio I will pay. Okay, if I'm not having any adjustment factor, now what will happen? 30 plus 100 into 50% is 50. 50 minus 30, so 50 rupees I will pay because it is based on this month dividend. But adjustment factor na, at the time where you're deciding, how much of target dividend pay, how much of target dividend is what you have earned. That is what is adjustment factor. What is adjustment factor? Adjustment factor na, current dividend. Okay, this is the current dividend by what target you have reached. My target payout ratio is 50%. So 50 rupees out of this 50 rupees till this time, how much is you have raised? How much is you have reached? That is what is adjustment factor. Adjustment factor is nothing but the current dividend to adjust the target. We have something called as current dividend. We have something called as target dividend. So how much we have reached till then. Okay, so that is what is adjustment factor. You don't have to think too much about the adjustment factor because this will be given in the question. Okay, this will be given in the question. But this is nothing but the dividends to adjust the target. This is a factor to adjust the target. To adjust the target. Okay, this is the factor to adjust the target. This is nothing but the speed of adjustments. Okay, this is nothing but if I say that okay, 45% of my target is already completed. Okay, 45% of my target is already completed. Now okay, 50 minus 30, 20. Okay, in this 20, 45% of my target is already completed. So 9 rupees the dividend that I can give now. 9 rupees the dividend that I can give now. So 9 plus 30. Okay, 9 rupees the extra dividend. 9 plus 30, 39 rupees I should give. Okay, by having an earnings of 100 rupees and target payout ratio of 50 rupees and adjustment factor of 45%, okay, adjustment factor of 45%, and this dividend of 30 rupees, I will give D1 is equal to 39. Now, forget everything. If you're not understanding the logic, forget everything. Lintus model. Lintus model is not giving price formula. Lintus model is giving the dividend formula. What is the dividend that you give? Previous year dividend definitely we should give. Okay. Current one, what is the extra I will give? Okay, current year, what is your earnings? EPS. EPS minus, okay, EPS minus what you will do? EPS minus what you will do? Ayo. EPS into what is the target payout ratio? Target payout ratio. Okay. So this is the total. What is the extra dividend? Into D0. This is the extra dividend into adjustment factor. Okay. This is what is the formula for Lintus model. Let me see one problem for you. Nothing to worry. Usually in these types of problems, numbers will be directly given. Lintus model. It is removed, huh? Say, okay, I think problem is not given. This is the formula. Problem they have not given. Okay, problem they have not given. But I'll tell you, usually what will be the formula? Sorry, what will be the problem? D0 will be given, EPS will be given, target payout will be given, AF will be given. You just have to calculate the number. Okay, nothing to worry. 6th standard problem. The only thing is a 6th standard student don't know the formula. Okay, you know the formula. Okay, the calculation is 6th standard. Done. Walters is completed, Gordon's is completed, Graham and Dodd. Okay, Graham and Dodd is completed. Graham and Dodd, and this. Now I'll tell you one method. Okay, now I'll tell you one method. Now this is one approach that I used to follow as a student. Okay, I used to follow as a student, and that has helped me a lot. That has helped me a lot. What you have to do is that whenever you want to revise something, okay, then this applies in all the subjects. Okay, not only in FM, this applies in all the subjects. Whenever you take, always take, okay, one empty paper. Just take one empty paper. Just take one empty paper and okay, just see, okay, today I want to revise summa, just take dividend decisions. Okay, just write dividend decisions because I'm doing dividend decisions though. Okay, dividend decisions. What are all the things you know? FM na formula you know. Okay, just write. Okay, Walters model. Okay, Walters model. P0 formula. Okay, what will be the formula? Okay, D1 plus E minus D into R by K, the whole divided by K. Very good. Gordon's model. P0 is equal to, what should be the formula? What should be the formula? Okay, D1. I should not write D1. E1 into 1 minus D, the whole divided by K minus BR. Very good. Okay, what is the other formula? I know Graham and Dodd model. Okay, Graham and Dodd model. P, what should be? So here dividend is having full weight, earnings is having less weight. So this into some multiplier I have to do. Okay, very good. Now what is the other formula I know? What is the other formula? What is the other formula? I know. So Walter's model, Gordon's model, Graham and Dodd's model, Linter's model, I know. So Lintus is not telling price formula, he is telling the dividend formula. The current year dividend is based on last year dividend. So D0 plus extra dividend na EPS into target payout ratio. EPS into target payout ratio. Okay. So extra na I have to do minus D0. This is the extra, and then I have to multiply this with adjustment factor. I have to multiply this with adjustment factor. Okay, dividend decision. One more formula is there, MM approach. Okay, MM approach. MM approach. I have not till now I have not discussed it, but I'm writing MM approach. What is the formula? So MM approach is giving you the price formula. P0 is equal to P1 plus D1 divided by 1 plus KE. Okay, divided by 1 plus KE. And there is one more formula for value of the firm. Okay, value of the firm, or you can also write as N into PO. Value of the firm. Okay, value of the firm, or N into PO. So value of the firm, what is the formula? The formula for value of the firm is equal to N plus delta N, okay, into P1, N plus delta N into P1, okay, plus, okay, plus what I have earned minus what I have invested, the whole divided by 1 plus KE. Okay, these are the formulas. These are the only formulas that are there in dividend decisions. Now what will happen is that once you write all the formula in one page by your own, okay, with your own brain, don't open the textbook, then you know the level of confidence that you will have, you will not be able to match. Same way, just write cost of capital. Okay, same way. Okay, same way. What you do, just write cost of capital. Same way, just write cost of capital. Cost of capital. Okay, KD. Okay, KD. I have two formulas. One is I into 1 minus T divided by net profits. Second formula is I into 1 minus T plus RV minus NP, the whole divided by N, the whole divided by RV plus NP, the whole divided by 2. Very good. KD formula. Now what is the formula for KP? KP is equal to preference dividend divided by NP. This is for irredeemable, this is for redeemable. Redeemable, what is the formula? PD plus RV minus NP, the whole divided by N, the whole divided by RV plus NP divided by 2. Very good. Now what is the next one? Okay, cost of retained earnings. Cost of retained earnings is generally equal to cost of equity. But if we have any brokerage, then you have to do 1 into brokerage. Okay, or if you have any flotation cost, then 1 into flotation cost. Okay, 1 into flotation cost. Or if you have any personal income tax, so 1 into minus personal income tax. Okay, not corporate income tax, personal income tax. Very good. Okay, KR formula I know. Then what is the formula? Next one is KE formula. Okay, KE I have some 1, 2, 3, 4, 5 formulas I know. Okay, what is the formula for KE? The first formula for KE is equal to DPS divided by MPS, constant dividend earnings. Then the second formula is EPS divided by MPS, constant earnings approach. Then the third formula for KE is dividend growth model. So dividend growth model, how I will do? Dividend growth model, how I will do? D1 divided by P0 plus G. Okay, dividend growth model. Okay, fourth one, CAPM. CAPM K is equal to risk-free rate plus beta into RM minus RF. Okay, cost of equity formula also I know. Then what I have to do? I have to do weighted average cost of capital. Weighted average cost of capital is nothing but costs into weights. Okay, cost into weights. If you do, you will get weighted average cost of capital. Weighted average cost of capital. Weight, we can do two weights. One is book value weight. Another one is market value weight. Other one is market value weight. Okay, this thing is done. This thing is done. Anything else we are missing? We have one more approach, which is nothing but realized yield approach. I think realized yield approach, yeah, one more thing. Okay. KD, I already said you, this is approximation method. Then we have YTM method. We have one more method. It is nothing but YTM method. YTM method is equal to IRR method. I will tell you what is IRR method. Okay, I will tell you what is IRR method. I mean, you already know what is IRR method. It is just that the same cash flow you have to find out the IRR. That is what is the rate. Okay, that is what is the rate that you have to apply. Okay, now the next one, okay, YTM method, IRR method. Now the next one, IRR method is, see, whenever you're having any debentures, when you're issuing any debentures, you will get to know the cash flows, correct? 0th year, okay, but in here alone you will receive, okay, 0th year you will receive net proceeds, you will receive. Suppose the debenture you are issuing, you are receiving 100 rupees, okay. 1 to 10 years you are paying 10% interest, correct? You're paying 10% interest, so 10 rupees the interest. And 10th year again you are redeeming the debentures at 100 rupees, okay. 10th year or again redeeming the debentures at 100 rupees. Now what you have to do, you have to find out the IRR. Okay, you have to find out the IRR. Here the IRR will be 10% because nothing is there. But suppose if you're redeeming at 120 rupees, then the IRR will be not 10%, it will be somewhere more than 10%. So how you will find out? First you have to calculate the percentage, okay, 13% or 15% you have to calculate. Or what you have to do, I will tell you one easy method. First find out, okay, with this cash flow, first find out the approximation method, what is the amount that you're getting. Suppose approximation method you're getting 12.5%, okay. Suppose approximation method you're getting 12.5%. Apply 12% here, see what is the NPV you're getting. Suppose NPV what you're getting is say 25 rupees. Then you apply 13% and see whether you're getting -10, and then using that you interpolate and find out the rate. Okay, YTM is nothing but IRR of the cash flows of the debentures, But here one more thing what you have to note is that when you are calculating IRR for capital budgeting, when you are increasing the rate, your NPV was getting reduced. But here, since it is cost, you will increase the rate, and NPV will also increase. Okay, so when you're getting a positive, you have to decrease the rate to get it negative. That is only one point you have to see. Okay, so IRR method, YTM method. We are revising again and again everything. But where were we? Yeah, the method. I was telling you method. So what you have to do whenever you're learning financial management, okay? Whenever you're free, take a paper, write the chapter name, write all the formulas, anything write anything you will get to know whether you are able to retain things in mind or not. You will get to know whether you are able to retain things or not. Suppose while writing, if you are not able to recall Gordon's formula, you will get to know that you are weak in Gordon's formula. You will take the book out and then you will study Gordon's model. So this is called selective study. Whatever you know you're not studying, but whatever you're not able to retain, you're studying again. Okay, whatever you're not able to do, you're studying again. So that is what is the best approach. That I have used. It has worked very well for me. That is one method. I'll just tell you small methods, okay, for you that will help you to speed up your preparations. Okay, even though if you're not comfortable with your preparation, these things will give you confidence and comfort in preparations. Okay, that is point number one. Point number two, okay. Point number two, what you do, I know approach is pending. Just hold approach and listen to me. Okay, listen to me once. Point number two. What is the point number two that will help you in preparations is that everyone is having laptop or phone, anything you're having, right? So whenever you're having any laptop or phone, what you do, go into ICAI website. Okay, go into ICAI Board of Studies knowledge portal. In that knowledge portal, okay, any year, anything you download, anything. Either you download MTP for 2019, or you download RTP for 2022, or you download a suggested answer last May, anything, okay? Randomly, you only have 3 materials, okay? MTP, RTP, and previous year question papers. And you have for many years, okay? In ICAI website or in any other website, you will have many year paper, okay? Randomly select anything, okay? From past 3 years, 4 years, randomly select anything. Say you say you have selected RTP November 21, you have selected, okay? Say you have selected anything, okay? This is the thing you have selected. Download the FMRTP. Summa, okay? Summa. Don't think that I have did this or not. Summa you download, okay? Summa you download, and randomly any question you take. So suppose if you're having 15 questions of FM now, randomly, okay, what is the number I took? Okay, 13th number I will take, okay? 13th number I will take. See the 13th question, okay? See the 13th question, because this becomes like a surprise. This becomes like a surprise because now you don't know which paper you're selecting, you don't know which question you're selecting, you don't know which chapter it is. So it is like an exam, okay? It is like an exam for you, but you're not actually writing exam, okay? But this will actually, this I was trying to gamify the subject, okay? I was trying to gamify the subject. This was something that I used in my preparation. It has worked very well for me, and when I will use, I will tell you, okay? First you listen to me. 13th question you take. Now say 13th question is from capital budgeting. 13th question is from capital budgeting. You don't know anything, okay? Even though you didn't study capital budgeting, just take this question. Just take this question. Even though you didn't study some chapter, don't worry. Just take this question, capital budgeting. Read this question. If you're reading this question, you'll get to know something. You'll get to know something. If you're not able to understand anything, see the answer. First try to solve. If you're not able to solve, see the answer, and then you again try to solve. You will be able to solve, okay? Suppose the question is based on, say, capital budgeting. The question is based on, say, capital rationing. The question is, that question was based on capital rationing, okay? Just an example. Now what you do, you are reading the question, you took the question, you read the question, you didn't understand, then you saw the answer. Once you saw the answer, you were trying to understand, you understood, then you again tried to solve the problem, you were able to solve, and you found out which topic is this. Then you found out this is capital rationing. What you did, you opened the textbook, okay? Then you open SM, okay? Then you open SM. Oh, SM are not strategic management, study material. Then you open study material. In study material, you see this topic, capital rationing, and see what are all the things that are there in capital rationing, what are all the things that you missed, what are all the other questions are there, and you cover this entire topic of capital rationing. Because now you know, you understood, then capital rationing will be completed. Then see left side of capital rationing, what is there? You will see left side of capital rationing, NPV is there, IRR is there, MIRR is there. Okay, read NPV, read IRR, read MIRR, try to understand, try to see the problems. Then you see right side of the capital rationing, what is there? You see right side of the capital rationing, we have some 2 or 3 capital budgeting problems. See that capital budgeting problem, solve that capital budgeting problem. You will get to know in some time capital budgeting chapter 50 to 80% you completed. Just by playing itself, you completed. That is how I did, okay? That is how I did. So I didn't plan, okay? Like today 2 o'clock I will open capital budgeting chapter. 2 to 3 I will study capital budgeting. 3 to 4 I will study this. 4 to 5 I will study this. I didn't do anything like that, okay? I didn't do anything like that, okay? They see different things work for different people. This thing worked for me. So whenever I didn't have a mood, because when you're keeping a time now, it becomes very strict. If you are a very disciplined person, and if you're a very strict person, you follow that. But if you're not very disciplined, if you're not a very strict person, if you're very easy on yourself, then you follow this method, because this method will give you surprises, okay? Whether you know or not, you're actually questioning yourself, you're actually seeing the question with curiosity, you're reading the question with curiosity, you're answering with curiosity, okay? Because everything is new for you. So don't be curious in exam hall, be curious now, okay? Do all the trials and errors now. Anything you're doing in the exam hall will not be will not give you good fruits, okay? Whatever you want to do, all the trials and errors, do it now, okay? Do it now. Now I will tell you when I was using this method. See what is happening. Suppose I slept, okay? Suppose I slept. So tension la, I woke up at 3 a.m. Tension la, I woke up at 3 a.m. There are 2 chances. One, I will go on see phone. I will go on and I will see the phone. Second thing what I used to do. Second thing what I used to do. No, I don't have to use the phone. Something I want to do interesting. Okay, what I will do? I just gave myself a challenge. Okay, something I will download. Okay, first what subject I should choose. Subject also I didn't know. Okay, let's take accounts. Let's take advanced accounts. Let's take advanced accounts. So what I used to do, suma laptop open பண்ணிட்டு, okay, MTP 2022 advanced accounting November paper download. 2 MTPs are there, January MTP download. Okay, January MTP download. See question number 3. Okay, see question number 3. Suppose question number 3 was based on partnership accounts. Okay, question number, okay, advanced account, there is no partnership accounts, right? Suppose it was based on NBFC. Okay, NBFC advanced accounts, it was based on NBFC. Now what I used to do, okay, nothing, no rates I remember. Okay, NBFC, no rates I remember. What I used to do, still I saw the problem. Summa I tried to solve. I know I don't know any rates. Then I saw the answer. I saw what are all the correct rates. Okay. Then I tried to solve the problem again. Then I opened the textbook. I read all the rates, what are given in the question, what are not given in the question. I saw some illustrations, saw some example problems of that particular topic. And then on the left side of that, what are all the connected topics that I can cover. Right side of it, what are all the connected topics I can cover. Because I was gaining interest in insurance. I was gaining interest in NBFC chapter. And with interest, in no time, it was 3 o'clock, right? Now it is 6 o'clock. This chapter is completed. My NBFC chapter is completed. 6 o'clock NBFC chapter is completed just by playing. Okay. I didn't plan that I will study accounts. I didn't plan that I will study NBFC, but see, my NBFC chapter is completed. So this was some kind of surprise. This was some kind of dopamine rush that I used to receive while doing this. So this is one tip, or you can say some tactic that I'm sharing with you. See if this works with you. If this works with you, do that. Okay. So don't waste your time. Instead of wasting your time, there's a movie in Tamil also. It's a movie Nanban. In Hindi, it's Three Idiots. So the hero used to say that you have to fool your heart. You have to fool your brain. You have to fool your heart. So like this only you have to study. See, not everyone is born to become all India ranker. Not everyone is born to become take 90 marks, or not everyone is so intelligent. God has given few people few strengths, few people few weaknesses. Not everyone is so focused. Okay, I am not that person who is very focused. I am a person who is very lazy goose I was. Okay, but still, how I used to clear CA is that I used to fool myself. I used to fool my brain. I used to fool my brain that no, okay, this is just a game, pa. This is just a game. And I used to generate some dopamine out of it. Okay, so that is how I used to do my preparations. And I wish that you also do this in this way. And okay, only one topic is remaining, right? Let me complete this. Otherwise, if I keep on talking, the time will go and then I will miss this. Okay. Approach, the formula for price. See, this is nothing, but this formula of price is nothing. This formula of price is next year, what will be my revenue? Next year, if I sell the share, I will get P1. And what is the dividend that I got next year? Suppose today the price is 100 rupees. So today I price, I don't know. Next year, I know. Next year, my price will be, say, 150 rupees I'm expecting, and I will get a dividend of 50 rupees. So what is my earning? My earning is 200 rupees. This 200 rupees is today's earning or tomorrow's earning? 1 year after earning. So 1 year after earning, I have to discount it to today's year. What is the discounting rate? 1 plus I. This is the present value factor. 1 divided by 1 plus I is the present value factor. So what I'm doing is that first year value I'm taking and I'm dividing it by 1 plus K, which means I'm calculating P0. So P0, approach ka formula is P0 is equal to P1 plus D1 divided by 1 plus K. P1 plus D1 divided by 1 plus K. Okay, very simple formula. Okay, done. Now, he also gave one more formula, which is how to find out the value of the firm. Okay, how to find out the value of the firm. Value of the firm is nothing but what is the value of the company. Okay, what is the value of the company? Now, what is happening is that how to solve any approach problem. Okay, how to solve any approach problem. Whenever this approach problem will be given, okay, whenever the approach problem will be given, details will be given. The share price will be given. Okay, share price P0 will be given. Okay, share price will be given, and earnings will be given. Okay, earnings will be given, investment will be given. Okay, what is the investment that you have to do? That will be given. K will be given. Okay, K will be given. Dividend. Okay, Dividend details will also be given. Okay, what is the dividend details will also be given. Now with this what you have to do, first you have to put this formula. Okay, P0 is equal to P1 plus D1 divided by 1 plus KE. Okay, P0 will be given, D1 will be given, KE will be given. P1 is what you have to find out. So what you are going to find out first is P1. P1 means price at the end of 1 year. Price at the end of 1 year. That is what you will find out. Okay, that is what you will find out. Done. This is what you will find out. This is the first step. This is the first step, calculation of price. Okay, calculation of price at the end of the period. Okay, calculation of the price at the end of the period. Okay, using this formula. Now come to second step. Okay, first step, minute. First step, calculation of price at end of period. Okay, the formula is P0 is equal to P1 plus D1 plus 1 plus KE. What you have to do is P1. I can directly, write this formula like this. P0, okay, P0 into 1 plus K minus D1 is equal to P1. But I should not confuse you. Okay, I should not confuse you. This is the logical way of formula. And just by having one unknown variable, you can calculate this. Okay. So P0, with this, you calculate P1. Okay, you calculate P1. Okay, once you've calculated P1, second, okay, second, what you have to do, you have to calculate funds required for investment. Now what will happen here is that they will give you that the company has earned. Okay, they will give you the earnings of the company is 1 crore rupees. Summa, for an example, the earnings of the company is 1 crore rupees. Okay, now they have distributed dividend of 50 lakh rupees. They have distributed the dividend of 50 lakh rupees. Now what is retained? Okay, what is funds available? What is funds available now? The funds available is 50 lakh rupees. Okay, the funds available is 50 lakh rupees, but they have some investment amount. Okay, they have some investment value, they have some investment proposal, so they need an investment of 2 crore rupees. They want to invest somewhere 2 crore rupees. Okay, they want to invest somewhere 2 crore rupees, they want to invest. Okay, so funds available is 50 lakh rupees, but investment required, what is the investment required? Investment required is 2 crore rupees. Okay, investment required is 2 crore rupees. So how much more fund is required? How much more fund is required? Huh? See, 50 lakh rupees is the fund which is available with them. Okay, 2 crore rupees is the investment which is required. So how much is the fund required? Fund required is 1 crore 50 lakhs. Are you all able to understand this? Nothing new I'm doing. What I'm doing is I'm just calculating what is the fund that I want. What is the fund that I want? Because the company wants to invest somewhere, na, some fund I should need. So 1 crore 50 lakh is the fund that I want. Okay, 1 crore 50 lakh is the fund that I want. Now from where I will take the fund? I will take loan or no. Here only equity shares can be issued. Okay, only equity shares can be issued. So third one is calculation of new equity shares. Okay, which is nothing but delta N. Okay, N na number of shares is that the opening number of shares there in the opening. Okay, opening number of shares. Okay, N na opening number of shares. Delta N is equal to new shares to be issued. Okay, new shares to be issued. Now, how to calculate delta N? How to calculate how much new shares? How much is the amount that I want? 1 crore 50 lakh is the amount that I want. At what price I can issue 1 crore 50 lakhs? I can issue at the price of P1, correct? Tomorrow I have to invest. So at what price I will issue? I will issue at the price of P1. So what I will do? I will divide this by P1. Then I will get delta N. What I will get? I will get delta N. What is delta N? 1 crore 50 lakh. Okay. Suppose I calculated my P1 was say 1,500 rupees. Summa I calculated. Okay. P1 is equal to 1,500 rupees. So how much new shares I have to issue? Okay. 1 crore 50 lakh divided by 1,500. I have to issue 10,000 shares. 10,000. 1 crore 50 lakh divided by 1,500. Okay. I have to issue 10,000 shares. I have to issue 10,000 shares. Okay. This thing you all have to calculate. Okay, this thing you all have to calculate. Done. Now what you have to do is that fourth one is find out the value of the firm. What is the formula for value of the firm? Value of the firm. See, value of the firm formula is that next year, okay, next year, what is the value? What is the value of my shares? So opening shares plus new shares that I've issued into P1. Okay, into P1. Opening shares I'm having, suppose I had already I was having 1 lakh shares. Okay, already I was having 1 lakh shares. Now 10,000 shares I issued. So 1 lakh 10,000 shares. Then what was the price as at the ending? So this should be, so you all will be thinking, okay, this divided by 1 plus K, this divided by 1 plus K. No. I have earned also something, and then I have also invested something. Okay. Here no dividend is that I have earned something and I have also invested something. Okay. Plus E minus I. Okay. Plus E minus I divided by 1 plus K is equal to value of the firm. Find out the value of the firm. Okay. Find out the value of the firm. That is what is the MM approach. So under MM approach, if you see under MM approach, two cases will be given. One case, if dividend not paid, if dividend not paid, and if dividend paid. If dividend paid. Okay. If 1 minute. See, if dividend not paid na, you have to put this as 0. Okay, you have to put this as 0, and then you have to calculate the funds required, and then you have to calculate the P1. Your P1 will be different and your value of the firm will be different. Okay, you have to do this calculation and you have to find the value of the firm. You have to do this calculation and you have to do the value of the firm. Okay, see, surprisingly, your value of the firm will be same for both. So according to MM, whether you pay the dividend or you do not pay the dividend, your value of the firm will remain the same. How to calculate the value of the firm? I have given you the approach. How to calculate the value of the firm? I have given you the approach. So this is the approach. Okay, n plus delta n into P1 plus E minus I, the whole divided by 1 plus K. Now I will give you one shortcut, or one very good point. Many of you will know, many of you will not know. Even before starting to solve the problem, you will already have answer in your hand. Okay, you will already have answer in your hand. Okay, value of the firm is nothing but n into P0. N will also be given in the question. P0 will also be given in the question. But you don't put value of the firm is equal to n into P0. Okay, this is the only formula. But the answer that you're getting, you just check whether it is equal to n into P0. Okay, even before solving, you know the answer value of the firm. Okay, so this is just a small thing that I want to tell. Okay, now see, I will tell you. Suppose this is the question. Okay, this is the normal MM question. Okay, normal MM question. Belongs to risk class where capitalization K is equal to 10%. It currently has outstanding. So N is equal to 10,000 shares. Selling at 100 rupees each. So P0 is equal to 100 rupees. Now what is value of the firm? N into P0. Don't write, this is just in your mind. Okay. So 10,000 into 100 is equal to 10 lakhs. So now, even before solving, you know that the value of the firm is 10 lakh only. See, what is the value of the firm? 10 lakh. What is the value of the firm? 10 lakh. This is, you already know. You just have to, put some calculations. So here, this is one place where you can easily find out your mistake. So even if your value of the firm is getting different now, something wrong you did. Okay, something wrong you did. By this you can identify this. Okay, so this is a sure, if this question comes now, you should just praise yourself because this question answer you already know. Just calculation part alone you have to do. Okay, so P0 you have, the firm is contemplating declaring a dividend of 5 rupee per share. So this is D. The firm is contemplating a declaration. So this is D1. Okay, at the end of the current financial year, D1. It expects to have a net income. Okay, net income of 1 lakh. Okay, this is E, earnings, and has a proposal for making new investment of 2 lakh rupees. So this is I. Everything you have. Okay, everything you have. First calculation of the first thing is calculation of the price. So P1 you found out 10 rupees. when dividend are not paid, first where dividend are not paid, so D1 you put at 0. Actually D1 is 5, but first case you have first case not paid, second case paid. So first case not paid, just put D1 as 0 and find out the price. Once you found out the price, what is the earning? 1 lakh rupees. Dividend you put at 0. What is the fund which you have available? 1 lakh. What is the investment that is required? 2 lakh. So if 1 lakh is the fund, total investment is 2 lakh. What is the balance fund that you should be requiring is 1 lakh rupees. So 1 lakh rupees, how many shares you have to issue? 1 lakh divided by 110. Okay. So 1 lakh divided by 110 is the delta N. So delta N is equal to 1 lakh divided by 110. So you know 909. Okay. 909 shares. Actually, it is 909.0909, but shares cannot be in fractional. So that is the reason they directly put here. So once they put here, the value will be in whole number. Okay. So either you put 909.0909 shares or 1 lakh divided by 110. Just put like this. Okay. Just put like this. Now, calculation of value of the firm. What is the formula? N plus delta N into P1 plus whatever I've earned minus whatever I invested into 1 plus KE. Okay, put this formula, you will get the answer 10 lakhs. Same way here you put just dividend is D1 is equal to P5, and here you put dividend distribution is equal to 50,000. You will get 105. Balance funds requires 1,50,000. Delta N you will get 1,50,000 divided by 105. Okay, 1,50,000 divided by 105 is 1428.57 share. But shares cannot be in fractional actually. But what we can do, we have to prove that both are 10 lakhs. So you write this or you write this. Okay, you just write. Then calculation of value of the firm, you put this formula, you will get 10 lakhs. Okay, this is how a typical problem will come. Nothing more can come in problem. Okay, nothing more can come in problem. So this is what is dividend model. Yeah, and one more simple problem can be see Walter's model. This is Gordon. Okay, if R is more than K, if R is more than K, now what should be the dividend payout ratio? If R is more than K, dividend payout ratio should be 100%. If R is less than K, dividend payout ratio should be 0%. Okay, so here what they are doing, okay, everything they're giving. So no optimum is required, but if this is Ditna, B is there, 1 by B is there, you just have to find out the price. So price in all the three forms you have to calculate. If retention ratio is changed from 0.6 to 0.04. Okay. Then new share price will be as follows. So if R is more than K, market value increases with retention ratio. R is less than K, market value has to decrease. So all these are analysis. As I already said, if you're not following the optimum payout ratio, your share price will decrease. Okay, your share price will decrease. Done. So I think now just a final view. Okay, just a final view. FM is not only practical. Okay, it is not only practical, it is practical 75 to 80%, and theory 20 to 25%. So ignoring theory, okay, will become a blunder. Okay, don't do that. What if one problem, what people think, I will leave the theory in choice and then I will take the other 4 problems, other 5 problems. Don't do this mistake. You don't know what problem will come. Okay, what if one problem you don't know, but in that theory, if you have read out of the 4 theory, at least 3 theory you know. Okay, so it is better to score 3-4 marks instead of 0 marks. Okay, so theory is very important. Don't think the theory I will leave in choice. And leaving in choice, leaving in choice is better. But actually you cannot ignore theory, because suppose you are having 4 questions, first, second, third, fourth, you will be having parts. Okay, A part, B part, okay, A part, B part, or C part. Here you are having A part, B part, C part, and D part. Here you will having A part. In A part you will have part 1, part 2, and then B part. Okay, you will be having question in parts. What if this one is theory, this one is theory, and this one is theory? What will you do? One question will be theory, but even in the middle theories are possible. Okay, even in the middle theories are there. I'm not telling possible, will come. Okay, because if they want to give something for 3 marks or something for 2 marks, now they cannot do a problem. So they will just put one line, some theory. Okay, some one theory they will put just for you to solve the problem. Okay, just for you to solve that. So never leave theory. You read the theory. Okay, you read the theory. That is very important. Coming to practical, always if you're having all the chapters, okay, if you're having all the chapters, if you're not having time to study all the chapters, you can leave only one chapter. Okay, you can leave only one chapter. That will be best. But if you're leaving 2 chapters, 3 chapters, then it will be very difficult. It will be very difficult. Try to score maximum marks in FM. Okay, that will lead you in getting an exemption. FM will lead you to gain an exemption, because economics is a sister subject of FM that is having 40 marks weightage. Okay, but we don't know out of those 40 marks how much marks we will get. Okay, but in FM you can be certain. If out of 60 marks you're studying very good, okay, you're studying very good, and even if you're getting 45 marks, okay, getting 15 marks from 40 is very easy. Okay, it is very easy. Economics also don't ignore. Okay, economics also don't ignore. If you have any doubts in economics also, you can ask. Okay, I can provide help in economics also. But don't ignore economics. Okay, don't ignore economics. It is very easy. I can't say very easy, but 4 chapters, 1 chapter 10 marks. Okay, out of which, you know, 1 chapter national income, mostly practical questions are coming, and other foreign exchange, money supply, you know, lot of other. Okay, I don't want to get into economics, but my only thing is target maximum marks. Always target maximum marks. Only if you're targeting maximum marks, your preparation will be at a good level. If you're targeting, sir, 40 vanda pothu, sir, then you are actually, I already said, right, you have to play with your brain. Then you are giving message to your brain that even if preparation is less, no worries. Okay, but if you're giving message to your brain, I have to target maximum marks, I have to target 80 marks, now your brain is getting fooled, and now it will work hard so as to get that 80 marks. Okay, practically 80 marks you're not able to get, not an this is not very you know, certain, but at least you will be able to you know, reach the exemption stage. That is what I'm telling. இது இந்த டிராவர் உள்ள left side. So yeah, so even if you're you know, targeting for 80 marks, it is very easy for you to get. Now people will be telling, sir, not everyone is so smart like you, sir. See, I am also not smart. How do you know about me? Just because I'm teaching FM, I'm not smart. What I used to do is that I used to gamify this subject. I used to, you know, focus more on the concepts, focus more on the logic, focus more on understanding things. And one more thing, CA, why people say CA is tough? Why people say CA is tough is because you cannot play with your strength. Okay, if my strength is practical, I cannot pass CA. If my strength is theory, I cannot pass CA. Okay, just because I'm having a strength in practical, I cannot pass CA, because if you cannot pass CA based on your strength. Okay, if my practical is my strength, na theory I will get dabba. Okay, if theory is my strength, na practical I will become weak. So you have to balance. It is your strength, so you have to, you know, you have to try to get more marks. But if it is, you know, but if it is not your strength, still you have to study. You know, you have to study in such a way, that you at least, you know, get whatever you're targeting. Okay, you at least get whatever you're targeting. And one more, the final advice that I want to give is, fool your brain. Okay, fool your brain, fool your heart, and only then you'll be able to go ahead. Because in this age, we have lot of distractions. That this thing or this thing, even heart gets distracted, even brain gets distracted. So fool your brain, fool your heart. Okay, if any beautiful lady is coming near you, just fool your heart. Hey, this she's just beautiful from outside, from inside nothing is there, like this. Okay, Suma, you say something. Okay, Suma, you say something, and you distract yourself, you fool yourself, and then you have to achieve your targets. Okay, so this was my you know, so all the best. If you have, yeah, one more thing, I just want to share my number once again, if you're not having it. 90256 90256739114. So this is my mobile number. Please reach out to me if you're having any doubts, if you're having anything, okay? And even the feedback of today's class, I would be very happy if you could share me the feedback of how you felt, whether you felt good, whether you felt bad, okay? Somewhere where you need more support, or I'll try to, do that for you, okay? So yeah, and one more thing, Saturday and Sunday I'm having. So tomorrow and day after tomorrow I'm having. So Saturday is the concept revision class. Sunday is the problem solving class that I'm having at Royapetta. For more details, you can just message me. I will send you the link. Okay, I'll send you the link and I will send you the details. If you want, you can attend that also. So I think that's it. So you can take over and end the session. One minute. Yeah. Yeah. Okay. Yeah. Hello. Yeah. Yeah. Okay. Okay. Sure.
Hello, audible, right?
Yeah. Yeah.
Yeah, so just a minute, I'll get a doubts if anybody has in YouTube.
Sure. Sure.
Yeah. So no doubts from you. So shall we doubts if anybody has in YouTube?
Sure. Sure.
So Thofik sir, shall we conclude?
Yes. 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 We can wind up. Yeah.
Yeah. So thank you so much, Thofik sir, for your valuable time that you have gave to our students. In case of any doubts, as you have shared your number, the students can get back to you, I hope. And in case of any PDFs that has been used, please do share with us so that we will put in a group description of us. And
Sure. Sure.
and to be very honest, journey over 2 days with respect to FM classes have come to an end. And that has been a very wonderful journey for the students, I hope. And we are getting good feedbacks as well personally though. So thank you so much for your help, sir. And something that I want to say is I see some quotes that you have shared at the end of the meet. Fool your brain and heart.
Yeah. Yeah.
Yeah,
So yes.
so as it goes, so the students shall follow the same with respect to the exams and they shall clear FM with very good marks. And that's it. Thank you. Thank you so much, sir.
Yeah, hopefully. I also want to, specially thank Rahul and also SICASA for first of all giving me this opportunity to connect with the students and also, share whatever I was having. And I'm feeling very overwhelmed, to take this class. I even said this to Rahul before. And thank you very much for, giving me this opportunity. I hope I did justice to the subject. I hope I presented well. So even after this, if you need any kind of support, please do reach out to me. Yeah.
100%. Thank you. Thank you so much, sir. That means a lot.
Sure. Sure. Thank
Means
you.
a lot. Thank you. Thank you so much, sir.
Okay. Thank you.
So, sir, I'm concluding the meet.
Sure. Sure. Sure.
That's right.